little bit when working for bank. Bankers have the most knowledge of FEMA because they deal maximum in FEMA cases if you're dealing with NRI division and all other. So of, out of 15, I think only one have very basic from CA panels. If you can still remember CA finals, it is almost half the same logic. But now what happens between our CA finals and today, a lot of things got changed. And if you are not aware, it might have a impact in exam. So let us first understand two, three basic questions which are coming on FEMA, very basics. A lot of people must be aware of this. So let's have understanding how much we know. Anybody can answer this? So now, do not ask me the question now. What is FLA? What is FEMA? I have not explained anything. We are just trying to understand whatever basics we are aware on, because this is not in the courses, but in exam they're asking such a basic questions. So those who are not aware, let me give you a background. FLA is Foreign Liabilities and Assets Return. So there is a regulation under FEMA and RBI that any entity, any company who has foreign liabilities and assets need to file a return under RBI online portal. So there is a regulation. Now, it is fine, Swaniji, we need to guess. Important is to need to guess. Correct, right, wrong, I will tell, or only the time will tell. But as of now, we need to just start thinking. Now, if at times you would have read newspapers, at times I'm talking last year, approximately last year, or this year also, if you would have read, a news would have came that RBI has extended the deadlines for filing FLA returns due to a lot of people were not able to file returns due to lockdown and other things. So if somebody would be reading newspapers thoroughly, he may get an idea. Now, what is the biggest mistake a lot of people consider, and it actually happens in exam. And I fully understand if you are not dealing in FEMA, it will look tough to you. But if you are dealing, it makes common sense to you. A lot of people choose exam options 20th June or 20th July, thinking just like GST returns, it has to be some return related to GST. उसका भी deadline 20th होगा because normally GST has a deadline of 20th. So 20th June and 20th July are incorrect answers. Then there are two left, 15th June and 15th July. So the correct answer is 15th July. So due date of filing foreign liabilities assets return is 15th July. Though the government keeps on extending, like for example, it was extended to 31st of July till this year. Last year it was extended to 30th of August. Because first time it was last year, it was the first time when it happened on online. Earlier it used to be a manual return that you on a balance sheet you give a manual returns, but now it is online return. So just try to note these kind of basic dates in exam. What is a time period within which we allot shares under FEMA? Saurabh ji, if you can recall from your CA finals, correct answer. So as per CA finals old time, it was 180 days. Old, if you see the old regulation, it was 180 days, but it got changed. And what it got changed? It got changed to 60 days. So those who are practicing company secretaries, they would be very well aware of these dates because the changes they know very well. But for us, if you're not practicing, if we have old memories of CA finals, it might have a strong impact in exams. So answer is 60 days. In 2016, so till, if you would have read FEMA 99, from 99 onwards till 2014-15, it was always 180 days. So they say if you're allotting to foreign shareholders, you can take time of 180 days period. But in 2016, Companies Act amended, FEMA got amended, and they say now FEMA regulations will be in line with Companies Act 2013 regulations. So in Companies Act, the time to allot is 60 days. So in FEMA also, it has been brought down from 180 to 60 days. Now this one would be mostly on How much you read newspaper or common sense? Mostly. A, B, C, D, four options. There are arrows. It is not A, B, C, D is not written, but still, if you consider first, second, third, fourth, or whatever options you think is uh, right, one, two, three, four, whatever you think. So majority's views is going to number two, and most of the time majorities are right. What is FDI? What is FPI? And why not? Why not the fourth answer is correct? Why not they both have equal impact? That we'll understand shortly. Now let's understand what exactly FEMA. See, FEMA is a very big subject, very big guidelines. They can't expect you to know entire FEMA regulations. What they expect you to know is very basic pointers. If you are aware of basic fundamentals of FEMA, very basic things, most of the things can be answered in exam. Very basic things. So first basic thing is how many, and we are talking as per FDA regulations, FEMA regulations. We are talking only of FDA regulations. We are not talking for loan regulations because there is a difference between taking a loan and taking a capital contribution, which is different. So according to you, how many type of capital instruments we have in FEMA regulations? Remember last time we discussed in Companies Act, we discussed there are two, equity and preference in Companies Act. Now in as per the FEMA regulations, please tell me how many types of capital instruments we have. If anybody can mention some capital instruments, whatever you think. Somebody need to, okay, CCPA, CCD, very good. So these are two, apart from equity share capital would be the first, second would be CCPS and CCD. What is the fourth one? So ECB is not a capital instrument. So what is ECB? ECB is external commercial borrowing. So it's a debt. So what is the difference between ECB and what the other three you answered? Equity, CCPS and CCD. What is CCPS and CCD? Are they debt or equity? Rajanji, what is your view? So they all are equity. So this capital instrument only talks about equity. It does not talks about debt instrument. So ECB do not come under FDA regulations. For ECB, there is a separate regulation. So there are four capital instruments. Anybody would like to give a shot on what is the fourth one? In exams, such a basic, simple question comes. Anybody can think of what can be the fourth one? Related to equity, I'll give you a hint. So four capital instruments, no, again GDRs are also borrowings. Global depository receipts are borrowings. You are taking the receipt with a condition of repaying back. So whenever there is a condition of repaying back, it does not fall under equity instruments. So there are four capital instruments as per FDA regulations. One, equity. Second, CCPS, compulsory convertible preferentials. Third, compulsory convertible debentures. Earlier, till 2007, there was an option you can issue optionally convertible under FDA regulations. But now it is mandatory compulsory convertible. So now you cannot issue OCPS or OCDS in FEMA. It has to be CCPS or CCD. The fourth one is equity warrants. These equity warrants normally are not prevalent much in use, but there are few entities who use equity warrants also. So equity warrants is one of the fourth capital instrument. What is the reason we have four capital instruments? What is the difference between equity and equity warrants? I'll tell you shortly. But just try to have a broad picture that we have four capital instruments. So what is convertible note? The note which you can convert, fold is a convertible note. That is not the right logic. Then anybody can tell me what is a convertible note, if you can think of. What do you mean by convertible note option? Converted to equity. Fine. Later point in time. Okay. So is it then my question to you, Subramanyam ji is uh, what is the difference between CCD, compulsory convertible debt, and convertible note? Because CCD will also be converted to equity later point in time. You are coming to the right logic. Your almost logic is there. You are almost there. My only one pertinent question to all the members. Yes, sir.
Is it short term versus long term or any time difference between note and debenture?
There is a time difference exactly, but more than time difference, there is one more thing. More than time difference. So, what is CC? What is the difference between convertible note and CCD? In CCD, the one who has invested in CCD, he does not have a choice to convert, not to convert. It is compulsory convertible, mandatory. There is one exception given, introduced last 3 years only, one exception in FDI regulations, that is known as convertible note. What does it mean? Any startup registered under DIPP guidelines in India. So if anybody is forming a startup and he is getting an investor from abroad, an investor says, I would like to invest in your convertible note. In that scenario, the holder will get an option in the 5 years period. So it is for five years period. In the 5 years, do he want to convert into equity or he want to take his money back? That is the only exception given for startups. Otherwise, in all FDI, we have a compulsory convertible. You cannot have a conversion choice. Only in convertible note, the option is given only to support startups, that anybody from abroad can invest in India, only for startups with a period of 5 years. CCD, you can always have issue up to 10 years, but startup, but OCD is banned in FDI. So in FDI, you can't have OCD, but it is similar to OCD. The only point we need to consider here is the choice is always with the holder. The company cannot issue that if we want, we can convert. So it is not at the choice of issuer. It is always at the choice of holder, the convertible note. Only for startups, and just note the period. Period is 5 years. Is foreign investment permitted in e-commerce business in India? Can a foreigners invest? I'm sure most of you would know this answer. Otherwise, how come Amazon, Flipkart would have been surviving? Correct. So foreign investment is permitted in e-commerce. Now tell me, foreign investment is permitted in e-commerce on what? What is the first prime condition that you're allowed to invest in e-commerce platform only on one prime condition? What is the first prime condition? If anybody can think and let me know, what is the first prime condition?
They will not enter in retail market.
Sorry. Please again come again. They will not.
They will enter in retail market.
They will not enter it in retail market. Almost you are there, but I'm still looking for one specific term, not one brand. Also one specific term. That is also I'm looking for. Yes,
RBI.
Multi-retail
I
brand.
think yeah. I think Rajanji and Vishnathanji has answered. The first condition, the prime condition is you have to be only pure marketplace. You cannot hold inventory in your books. It cannot start that Amazon comes in India and Amazon says, I am giving you a platform also. So whoever willing to sell comes get registered on my platform. And I will also, Amazon can also start buying inventories from various retailers and I will also sell on my portal. So that is not allowed. So the rule has been made that you can only give a marketplace, just like Ola and Uber can give a marketplace. Anyone who's have a car can himself upload his car, and anybody can want to take services. So in e-commerce, they made a rule that you should have only marketplace. So how the people?
Actually, now they have to change the concept. They are also manufacturing in the other company brand as per their specifications.
So now what they did? So wherever you make a law, there will be one smart consultant who will give a via media of the law. So one consultant gave an idea that it says pure marketplace, agree. Inventory should not be in your books. We also agree. Then what you can do? Make a subsidiary, take inventory in that books, and you will be deemed compliant of that law. So what all players did? Flipkart opened WNS tail, Cloud tail in Amazon. So they opened their subsidiaries and started holding inventories in those subsidiaries. And that is the reason when you see a 11th October or a big bumper sale discount, what they do, these people, they will buy a lot of stock from retailers, hold it. So if suppose Amazon goes to a Samsung and say, I will buy your 1 lakh phones. Give me, suppose a phone is worth 5,000 rupees. Amazon will say, I'll give you 1 lakh upfront order. You give me at 3,000 rupees. So Samsung may take a call that I'm getting a 1 lakh confirmed order now. I'll give you at 3,000 rupees, almost 40% discount at his selling price. Then what Amazon will do? Amazon will go on its website and say, now we are selling at 3,500. By this, what is happening? Amazon is making a 500 rupees profit, but in the end, they are damaging the Indian economy by destroying the worth which is of 5,000, giving a discount at 1,500. So it is crashing the economy. So that is the reason last year government was strict on this, and government says now you cannot also have a more than 50% holding in those subsidiaries which are holding inventory. So government has also understood after 1, 2, 3 years that people are flouting the norms. And a lot of retail associations have objected to this position. So they have complained to ministry. Now ministry has made a rule that you cannot own more than 50% in a company which is holding inventory, and you can sell on your platform. What is FDI and FPI? If anybody can explain me. Full form I know. Foreign direct investment, foreign portfolio investment. If somebody can explain me the meaning, and or somebody can
Well,
also answer me the first question where we say why FDI is better than FPI.
actually, FDI, they are putting the money in a kind of in a business or in the industry, and they are setting up the plant, okay, or making the investment in the present company. And FPI, they are making in the stock market and taking the money back. So FDI is more relevant than FPI. FDI will generate the employment and market in India, but FPI, they will in portfolio and they may can sell and at any time and go back.
Absolutely, 99% correct. Absolutely correct. The reason, first of all, what is FDI and FPI? It is foreign direct investment. FDI is any investment more than 10% in a listed company will be called as foreign direct investment. So if somebody is sitting in US and buying 15% shares of any listed company, it will be considered he has come as a FDI. It will be FDI. So 10% above in a listed company is FDI. Now comes the most important part. And any investment in unlisted company, 1%, 10%, 100%, any investment in an unlisted company will be considered as FDI. So FDI comes directly into the company. FDI comes into the unlisted company also. Whereas FPI only goes into the listed companies. Now, what is the main difference between FDI and FPI? FDI, anyone who comes in FDI, any investor who is coming as FDI will always come for a long-term purpose. Because when you are in unquoted investments, so if Samsung is setting up a plant in India, let's say for manufacturing mobile screens, they cannot immediately exit the country. Just like Toyota recently said, now we will not make the new cars. So you cannot immediately exit. Whereas in FPI, what you just need to do in FPI, if I really want to exit, suppose I am coming from USA and I have invested so much in India in FPI, and if tomorrow I want to exit, what I need to do? I just need to tell my broker, sell India, buy Korea, buy Japan. I just need to give an instruction to sell all my shareholdings. Immediately I can exit the country. So in FPI, nobody can stop, or it is very easy for them to exit. It is very easy. But in FDI, very difficult to exit at my choice, because it is always mostly you are in unquoted, and in FDI direct money goes to the economy, whereas in FPI you are playing with stock market, so it may or may not impact the economy directly. And whoever comes with FDI, majority of the time they will also bring their technology and their research and knowledge to the Indian company. So, for example, if Coca-Cola is making a Coca-Cola product in UK, same ingredient, same technology, they will also bring in India. But if you are FPI, you will never bring your technology to India, because your intent is not to grow the economy. Your intent is just to make double the money quickly and move out. You may gain more in FDI if you stay longer. So that is one of the basic difference between FDI and FPI. In exam, a question may come: can an unlisted company receive FPI? Answer would be purely no. FPI only on listed, less than 10%. FDI more than 10% on listed companies, and less than or any percentage in unquoted. What do you mean by foreign investments? Foreign investment means
Both FDI, FPIs.
what is the exact definition, or a near about definition? Apart from FDI, FPI, what do you mean by foreign
If
investments?
any country, abroad country making investment in India or any, then it's foreign investment.
Made in India, but again there is one more condition. I can agree. I understand the name itself suggests that you are receiving foreign investment in FC. Again, there is one more condition. So any money coming in India from abroad, but there is one more condition. On which basis? Whenever you fill government, if somebody has worked in FEMA, whenever you receive a foreign remittance, the first question dealer will ask, it is on which basis? No, not in receiving foreign.
Non-repatriable.
Exactly. So what is the correct answer? No. Source is all secondary. Source we will always see later. First is whether what money you are bringing in India, will you take out or no? That means will it be repatriable back or non-repatriable? So why the difference between, why they ask this question? It is a repatriable, non-repatriable. So the definition as per FEMA of foreign investment means any investment coming in India from abroad through regular banking channels on a repatriable basis, that will be called a foreign investment. That is, somebody in UK, let's say there is a NRI sitting in UK. He says, I want to invest 10 crores in India with a condition that I will also take it back whenever I want. So it is a repatriable basis. That means that it will be considered as a foreign investment. But suppose the guy says, since I am a born Indian, so I will invest 10 crores in India, but I will not repatriate. So it is on a non-repatriable basis. That means money will always remain in India. So if I bought 10 crore, it will remain in India. That will be the logic. In that scenario, this investment will not be considered as a foreign investment. So any investment which is coming with the condition that it will not be taken back, it will be non-repatriable, it will be considered as a local investment, and it will not be considered as a foreign investment. Now, which countries cannot invest directly in India? Remember there are two routes: automatic route, government route. Earlier, again, it is not for your exam, it is just to give an update, because in exam it happened after your exam, after the syllabus changes, so it is not relevant for you for exam purpose.
This is China and this
So
our eastern.
exactly, so what happened was, so we all know there was a border tension at with China. So China has lot of investments in India. So now government, it would be very hard for India to make an announcement that tomorrow onwards China will not make any investment in India. That may have a lot of repercussions on your World Bank and global forums, because if you are directly saying a country that we are banning this country, it may damage your bilateral relations. So what government played very smart, and I consider it a very smart move. So government made an announcement. Now those countries who are sharing borders in India cannot have automatic investment approval now. So they are not saying you cannot do that. You can do that provided you take a government approval. Earlier it was free. So we had a lot of investments in from China coming to India earlier, but now it is all happening because of whatever the tension escalated. So now all land border countries, and this the only thing, the reason we are mentioning you, once you come into practice of valuation, if you are issuing any reports of FEMA, you need to be careful that are you complying with the regulations or not. So because that will also become a liability of you to see whether you are making any caveats or not. So now any land country having a border with India cannot invest directly. There are two ways of coming in India: automatic route and government route. So there are various sectors where government has mentioned a limit. For example, textile company. So government says anybody who wants to enter into textile company in India, somebody wants to invest in India, up to let's say 100% you can invest without even asking. So those sectors where government thinks these are not critical for India, where we can still manage without any government approval, you can invest up to 100%. Take for example NBFC. You can invest 100% in NBFC from abroad even without taking prior approval from government. You just need to give intimation to RBI that you are getting a FEMA FDI regulations in NBFC. 100% it is allowed. But then there are certain government sector routes. For example, media. So government does not allow 100% companies to be owned by foreign, 100% media companies of India to be owned by foreign investments. So government makes a rule. Okay, up to 74% you can come automatic. If somebody wants to acquire more than 74%, you need to take a government approval. So there is one website, Department of Foreign Affairs, that is a one stop website where all permissions can be to all foreign investors can get from one website directly to avoid their hassle. What do we mean by group company? So in exam, a very basic question comes on what is the classification of group companies. Remember, this group company criteria is totally different, mostly different from what is in Companies Act. So normally in Companies Act, what is the criteria? Anybody can tell me in Companies Act what is the criteria to identify it is a group company or no? Generally in Companies Act, what is the criteria we have? If somebody can help me out with that. Significant influence, and what is the benchmark we take for percentage that we can say, okay, if you have this much of 20%, right? 20% is considered as the benchmark in Companies Act. That if somebody is having a 20% shareholding, you are considered as an associate company. In FEMA, the regulations are if you are having shareholding of more than 26%, if you are having 26% or more, it will be considered as a group company, or you have the authority to appoint more than 50% of the board. So either you can appoint the board of directors as per your choice, majority, more than 50%, then it will be considered as a group company, or you are holding 26% or more, then you are considered as a group company. So that is the definition of group company. What are the prohibited sectors where FEMA prohibits that investment is not allowed by any foreign companies, any residents? Defense. Pakka? Defense pakka?
No, defense allow 70 now, more than 70%.
That's what I'm saying. But now why the answer defense is coming? I'll tell you why the answer defense is coming. Because whenever we would have read FEMA, whenever we had cleared CA final exams or your respective CS and ICW exams, if you have FEMA in syllabus, at that time defense was a prohibited sector. Defense was not open sector.
Nuclear sector.
Atomic energy is prohibited. Railway operations is prohibited. Chit fund companies, nidhi companies, agriculture, real estate business, manufacturing of cigars, manufacturing of tobaccos, uh, uh,
But in
gambling
retail,
websites.
but in
Gam-
retail sector, there is a MR company of Dubai, and Trump Tower is also making in Gurgaon.
they are saying real estate business you cannot do buy and sell. You can do a development. I
Okay,
can
okay.
do a township development. A township development they have started. So I cannot do buy 100 flats today, sell 100 flats tomorrow. That buying selling I cannot do, but I can do a development of townships. So they've given a limit that if you are having a township limit of 3 million, 3,000 square feet, acre or some numbers, if you have that kind of investment and you have a minimum lock-in period of 3 years, then it is allowed. But you cannot do a trading of business of buying and selling of real estate property. So defense, so there is a change in defense. 49% up to defense is automatic route. Without even asking, it is allowed. Is this June 20, recently June 20, this got amended and now it is 74%. So 74% in defense, anybody can get it. 74% defense automatic route, no approval required. More than more than 74% if somebody wants to take in defense sector, government approval is there. In railways, a lot of people questions at times that when the regulation says in railways we cannot have a foreign investment in railways, then how did we got a bullet train 60 billion funding from Japan? What is the logic? So what does the regulation says? You cannot get a capital instrument in railway operations. What we got from Japan is not a capital instrument. In Japan, what we got is a debt instrument. So debt is allowed. So to create a metro train, a bullet train in India, we have taken a funding from Japan that is allowed. We'll come to prohibited sectors once we'll go to slide. We just need to remember a lot of people violate these rules of buying agriculture land. How do they violate the rules? The regulation says NRI cannot buy agricultural land. So anyone who becomes a non-resident, as per FEMA regulations, you cannot buy non-agricultural land, agricultural land. So what they do, they will give this gift amount to their brothers or sisters in India and buy in their name. Technically speaking, that is also not allowed because it is written even indirectly also you cannot give money to buy agricultural land. But a lot of people violate this, which is not allowed. Now comes the practical part, which a lot of you will go through once you become valuers. You'll get a lot of assignments for having pricing FEMA guidelines. So when we look into FEMA guidelines, whenever we are having a investment in India or investment out of India, mostly we are having investment in India. The regulations focus more on having investments in India. So they have given a guidelines, frequent and infrequent. Now this frequent and infrequent is applicable only for listed entities. Anybody can let me know what do we mean by frequently traded shares and infrequently traded shares in a context of listed company. Then we will see why these guidelines are applicable and why what is the reason of defining frequent and infrequent. Anybody would like to speak or chat, whatever makes comfortable to you? What is the difference between how much is a float? Correct, Vishwanathan ji, traded volume. What is the threshold? My question is on that. How much is this is the correct answer that we need. A traded volume is a threshold to determine whether the entity, listed entity, is a frequently traded shares or it has a infrequently traded shares. Now, if anybody can think what is the traded volume should be, 25% of what?
So at least 25% of the shares are tradable.
Okay. Are you, do you know this or you are guessing this?
So actually the promoters have to reduce their holding below a certain level, right? I think it has now come down to 75%. So that is why the balance 25% has to be public.
Fine. But again, 25 is not the answer. So do not, for other members, do not remember. The only reason, most of the part is correct. The only reason I was asking that, are you making a guess or you know it? So I want to understand the thought process where the number is coming. So he has a very good logic of getting 25%, but that is not the right answer. Because if I say 25% should be traded, that means I am assuming whoever is buying my shares all will definitely trade during a year. So practically that is not possible practically. So what does the regulations have defined in SEBI regulations and listing criteria? So the criteria is 10% of the share capital. So if I have, let's say, 10 lakh shares during 12 months, in the past 12 months, so if I'm doing a valuation today, I need to see past 12 months, how much would have been my trading volume? If my total trading volume during last 12 months exceeds 10%, then I can conclude it is a frequently traded company. If it does not conclude, then I will consider as a infrequent. Now, why this criteria is important? So if it is a listed company, let's say take example of Reliance Industries, let's say. Now Reliance wants to have some investment from abroad. So the first, since it's a listed company, what can be the best criteria? So if today some investor wants to come today, so shall I say, give me what is my today's closing listed price? Is that would be the right approach, or SEBI would have kept some more formula, or FEMA and SEBI would have come for any further formula? So any thoughts if you can give? So suppose Reliance Industries is a listed company and a foreign investor wants to come. Exactly. So there is not 30 days average, but yes, there is some average. So now common sense says government will not put a, because just saying one day price, it might impact the country in favor or might damage. So it may happen today there has been a significant fall. So I might sell the India's worth net assets of big company at a very dirt cheap away price. And it can have vice versa. I got some insider information, price may go very high. So investor even may not come at a higher price considering it's a bubble price. So they have given some guidelines. We'll come to that guidelines. So if it is a listed company, you need to see last 2 weeks listed price average closing and last 6 weeks, 2 weeks and 26 weeks. So that makes 6 months. So you see 2 weeks price average high and low and last 26 weeks, that is equivalent to 6 months. Whichever is higher, the shares will be transferred at that price. If it is an infrequent, now if it is declared that it is an infrequent shares, in that case, we will not go for a listed price. So where it is shown that in last 12 months, my shares only traded 2%. That means there is no proper float in the market. The transaction what happened may not give me a fair value. So the regulation says in that scenario, you just get a valuation done from a merchant banker, cost accountant, not cost accountant, merchant banker and a chartered accountant. Cost accountant will come in a separate category. So if it is a listed company which is infrequently traded, valuation will be done by either a merchant banker or a chartered accountant. That is one. Now, suppose if the company itself is an unlisted company by default, day one. I'll explain shortly, just wait for 5 minutes. I'll come to the respective slides. Here I'm just giving you an overview picture. Then I'll explain again all criteria in detail. If the company is unlisted, then the criteria of frequent and infrequent becomes irrelevant because it's unlisted, so there will be no trading. In case of unlisted, now here remember minutely, in case of unlisted, who will do the valuation? One, merchant banker. Second, chartered accountant. Who is the third one? I mentioned you.
Registered valuer.
I told you in the last session. I'm not sure did I explain this or not. That as of now, RBI and FEMA do not recognize registered valuer. As of now, RBI says and FEMA says, "हम आपके हैं कौन?" We don't know who are you. So if you don't know who are you, so third person cannot be RBO, right? So the third person is cost accountant. So just remember one thing: in entire valuations, FEMA and RBI, company secretaries are not authorized. So in exam, they ask a tricky question: to value a unlisted company, unquoted company, private company in FEMA regulations, who will do the valuation? CA, CS, ICWA, merchant banker, CA and merchant banker, CA, merchant banker, and cost accountant. So we need to remember, if it is a unlisted company purely, it can be done by three people: CA, merchant banker, and cost accountant. But if, and there is a difference, minute differences, understand. But if it is a listed company which has been classified as infrequent, in that case, the valuation will be done only by two people: merchant banker or cost accountant. So there is a minor difference here. Just remember that. Unquoted, we understand it can be done by any three people. How the valuation should be done? The regulation says you should do a valuation as per internationally accepted methodology. There was a funny rule in India. It was a very funny rule. Till 2010, in FEMA, any investment coming in India, suppose there is a newly set up company open, a very new set up company open, any investment which is come in India, the valuation will be done only and only by DCF method. That was only method allowed in FEMA regulations, that if any transaction is coming in India, do only DCF method. But then 2010 onwards, a lot of discussions happened with Ministry, MCA and RBI that there are international valuation says three method. So we can do a valuation as per any other method, whatever it makes sense. So it may happen a company is running in last 2 years in losses, and how can you expect a foreign investor to come and say, now you give me at a fair after 10 years value. So DCF will always go in future, but the investor will say, if it is in losses, give me, allot me at par value. I'll come at par, but I will not come at premium because currently your losses. So that was the regulation. Now in FEMA, you can choose any method. Even cost method is allowed. And normally, if the company is less than 6 months or 1 year and have no cash flows, cost method is acceptable by RBI. Now comes the regulations. Why this guidelines and what the guideline says for which person. PRO means person resident outside India is selling to person resident outside India. So suppose Infosys Limited is listed on NSE. A person residing in New York has a shares of Infosys Limited and our NSE. He's considering to sell it to person staying in Japan. Now, what does FEMA regulation say in this regard? Any idea? What guidelines FEMA will say in this regard? We are not talking of Companies Act, Income Tax, that act we will ignore. Just focus on FEMA and let me know, according to you, what do you think FEMA guidelines will say on this transaction? What guidelines they would give? Any idea? So we got one response from Mr. Mehra. Can be traded at any price. What about others? Pass. To pass an exam, we need to answer this question. So, Anilji, my query is, trading is allowed. Trading is not an issue. Trading is allowed. Does FEMA gives any guidelines that value at marketplace? Now, Swaniji, answer is incorrect. Now, you tell me why answer is incorrect. So, I'll tell you the answer. The answer is, FEMA says, do whatever you want to do. We are least bothered. Now, you tell me, Swaniji or Sudipta ji, any of you who would like to answer, why FEMA says we are least bothered, do whatever you want to do. You transfer at 1 rupee, $1, you transfer at $1 lakh, we are least bothered.
Ultimately, the money is not going to come in India. Maybe that is the reason.
So what is the name of FEMA? What is the full form of FEMA?
Foreign exchange.
Foreign
Foreign,
Exchange Management Act, right?
Foreign, Foreign Exchange Management Act.
Yeah, yeah.
So what is the logic of this act? The logic of this act is if my currency is getting impacted, then this law will come in place, right? So if the currency is not getting impacted, so if a Japanese guy who's holding shares is selling to somebody who is based in New York or vice versa, does it impact my currency? We are only talking of FEMA guidelines. I'm not talking of income tax and all other things. That is separate. It does not impact my currency at all, because if a UK guy, if a US guy is sapling to a Japanese guy, only the US and Japanese yen will be getting impacted. INR is not at all impacted. So FEMA has no regulations on that. So FEMA has no concerns. Whatever price you transfer, we are fine with that. Coming to a point where now comes a question where FEMA has to say something. A person resident outside India is selling his stake. So a Japanese holding a Infosys shares selling a stake to person resident in India. Then what does the guideline will say? And this is pure common sense. Pure common sense. What do you think the guideline will say? Sell, transfer at what price? Buy at what price? So as a resident in Japan will sell to resident in India. So Indian guy will buy Infosys shares from a foreign citizen at market price. Sushanta ji, again think, do you think? I think you mixed up the response. Value should not be lower or value should not be higher. If I am buying, an Indian is buying, what will government say?
It should not be lower, no?
I'm asking.
It should not be higher.
Correct. So what is the logic? If I am buying, if an Indian is buying from a person resident outside India, what the regulation says? The fair
That foreign exchange outflow.
so there is outflow. So there is outflow.
There.
So if there is outflow, what the regulation says, that transaction should not be more than the fair value. So suppose the fair value is coming at 100, FEMA has no problem. You buy shares at rupee 1 or you buy at 100 rupees. Below 100 till 100 at whatever transaction price you do, they have no problem. The moment you buy at 101 rupees, they will give you a notice. FEMA is very strict. FEMA says whatever the fair value determined by either the valuer, if it is a listed company by the formula, or if it is an unquoted company, then by the CA or merchant banker or cost accountant, your transaction cannot be higher than the fair value. Your maximum cap is fair value. So if fair value is coming 100 rupees, you need to do only at 100 rupees. If you go 101 rupees also, they will make a big fuss out of it. You can even buy at rupee 1, they have no problem. Similar would be vice versa. If a person resident in India is selling to person resident outside India, then what will be the guidelines? Again, the common sense says, then it will not be lower than the fair value. So suppose my Indian is selling to now somebody in UK of a shares of Indian company. So the fair value is 100 rupees. You cannot sell below 100. You can sell at 101, 1000. Government have no problem. But if you sell below 100, they have a problem. You cannot say, because here discount is not at all allowed. You cannot say par value तो 10 rupees है, अभी fair value 100 आ रहा है तो मैंने 100 का 90 में बेच दिया तो क्या फर्क पड़ता है? Par value I am met with par value. No, the logic is whatever the fair value you are getting, that should ultimately received by Indian entity. Because what it means that If I sell something at low, and what is the government problem in this? Suppose we are selling a company, let's say example of BPCL. So BPCL is a Navratna of government India company. Now if somebody, and BPCL, let's say fair value is 100 rupees per share, let's say, and some Indians sell the shares of BPCL to somebody in foreign at 50 rupees. So what is happening in the end? Ultimately, he made a loss of 50 rupees, that is separate. What is the government biggest problem? The government two biggest problems. First, you are selling the country resource to a foreign citizen at a cheap price. Second, he will be able to win. So my currency, I received only 50 rupees. So my yen impact, so my dollar and INR impact will be only 50 rupees. But when this guy want to sell, he will take out 100 rupees, which is a bare minimum fair value. So in that scenario, my major economy currency will get impacted. That is the reason government is very strict. You will be surprised. There was a fair value report where the value came. Let's say, I'll give you a hypothetical example. Amount is not exact, but context is exact. It came 110.17 paisa. That is a fair value came as per the valuation report which merchant banker has submitted. So 110.17 paisa. When the transaction used to happen, when the shares were about to issue, a company secretary issued the shares at 110 rupees just to avoid the rounding of difference. You know, 0.17 will make a lot of rounding of difference and extra. So he rounded off to 110 rupees and issued the shares and filed the form, whatever the form numbers, FCGPR and other forms to the authorized dealers and RBI. RBI hold that assignment. They say, why did you round it off 0.17 paisa? It is not your right. Whatever the valuation has given a report. Had the valuer would have given 110 rupees, we could have fined. But if he has given a value of 110.17 paisa, you don't have the authority to round it off. So RBI is very strict on that. So whenever in future you do such FEMA assignments, be very careful. RBI looks into the certificates, and who will question your certificate first? And what is the best part of doing FEMA certificate? The best part of doing FEMA valuations is it gets double checked at two places. First, it gets checked by authorized dealer. What is the concept of authorized dealer? We directly do not deal with RBI. So RBI says we cannot directly deal with individuals or companies. So we are making authorized dealers. Generally, all banks are considered authorized dealer generally. So all banks, insurance companies, and big companies are considered authorized dealer. You give, suppose you are a bank, let's say ICICI Bank. So you will give your valuation report, everything to ICICI Bank. ICICI Bank team, their FEMA team will check all the reports. They will cross question you all the things. And after that, again RBI will do a double check. So generally, whenever it goes to RBI, normally authorized dealer does all this scrutiny. So nothing left at RBI to check. Because RBI puts a very heavy penalty on authorized dealer. Suppose if I send a wrong report, the first implication will not happen on me. The first implication will happen on authorized dealer. We'll come to these guidelines more to understand shortly. What do we mean by downstream investment? So a simple question comes on this. What do you mean by downstream investment? So I'll give you two examples. You let me know which example is considered as a downstream investment as per FEMA regulations. First, company A is in Australia. They invested in company B, which is Britain. So Australia invested in company B, which is Britain, based in Britain. That company B invested in company C, which is based in Chennai. That is first option. Second option, company A based in Australia invested in Mumbai. Company B is in Mumbai. Company B invested in company C, which is in Chennai. Out of the two, A and B, which is a downstream investment as per FEMA guidelines? So what does FEMA guidelines understand? Whenever any entity who receives foreign funding So which is option B in this scenario. If they further invest in another Indian entity, then it will be considered as a downstream investment. It will not be by Australia going to Britain, Britain going to India. That will not be downstream investment as per FEMA guidelines. Now, who all can receive FDI instruments under FEMA regulations? Anybody can let me know? Who all can receive? Company, LLP, partnership firm, HUF, individuals. Can a partnership firm receive? Yes, no, maybe. सोनी जी सिंह मिल सकता है, बोले आती लक्ष्मी को मना नहीं करना चाहिए, जो आ रहे तो आने दो, किसने मना करा? So what does the FEMA regulation strictly talks about? FDI FEMA instruments can only be received by company or LLP. These are the only two available. Partnership firm, HUF, individuals cannot receive any foreign funding as per FEMA regulations and FDI regulations. Now, this downstream investment, yes, private limited company is also. Company, we assume company means private limited and public. They can receive FDI. Can the downstream investment which we are discussing, suppose Australia invested in company which is based in Mumbai, so Mumbai company received it. Can Mumbai company do a downstream investment in partnership firm? Yes, no, maybe. So the regulation is very clear. Even the downstream investments cannot be done in partnership firms or HUFs or individuals like a sole proprietor business. You cannot do that. So if the regulation is saying straight away no for something, you cannot find a why media, because a lot of people at that time started, let's make, because you are not allowed in partnership firms. So they take a investment in parent company and try to put into partnership firm. Then it was stopped. Now, before we go through the slides, I'll take 5 more minutes to ask few random questions to understand and understand the concepts. Can we? I told you a definition of FDI and FPI. So more than 10% is FDI, and less than 10% is FPI. Suppose a company which invested in India, they invested at 15%. They were holding 15% in that company. So now they are classified as FDI. During the year, the promoters issued further round of shares and distributed to local shareholders. So the company which was holding 15%, their shareholding reduced to 9%. That is less than 10%. Now for reporting purposes, that company will be considered as FDI or FPI. Nobody with FPI? Okay, only one with FPI. Okay. Now, what does the regulation says? Regulation says, and FEMA has very clearly mentioned in the regulations, whatever shape and form you enter into India, till the time you exit, you will be recognized in the same shape, same form. So when at the time you came to India as FDI, even if your shareholding reduced to 1%, you will be still considered as FDI only. Just because your shareholding changes from more than 10% to less than 10%, your nomenclature will not change. And for all reporting purposes, you will be considered as a FDI. The question we asked for foreign investment, which is coming for a repatriable basis. What will happen to the foreign investment which is coming from abroad, but on a non-repatriable basis? So that will not be considered as a foreign investment, and for the purpose of FEMA regulations and for the purpose of capturing the percentages, for example, if it is said that defense 74% is only allowed, so this investment which is coming from abroad, for it is not coming for repatriation basis, it will not be considered under 74% category, even though it is coming from abroad. So the objective is whatever is coming for a non-repatriable basis will not be considered in the guidelines of percentages holding. That is a basic assumption. Another thing from we got FEMA. Let me think one more 2-3 questions before we move. FEMA guidelines. Okay. Now let's understand basic things. We are asking something. Okay. One question. So there are certain sectors. There are certain sectors where percentages are required to be maintained. For example, let's say in insurance sector, more than 74% cannot be invested from abroad. That 74% is the limit. Suppose who is so and I am a foreign investor. I invested 2% more. Now your limit goes to 76%. It breaches. So the limit got breaches, right? Who is responsible for it? The investor or the company? So the compliance has to be always ensured by the company. Investor is not at all responsible because I don't know what your other shareholders are having. I only know I am making investment. Right or wrong, it is your registrar agent, your custodian. They need to stop it. You cannot blame me. So now the damage has happened. You have already breached the limit. What will you do now? The limit has been broken. How to rectify? 74% allowed tha. We invested 76% by mistake. It was a human error. Approval किसका? RBI को बोलें कि हमारा 74 था, हमने 76 कर दिया, तो allow us to continue 76. So will RBI or government allow continue to keep 76? We are just discussing. I am not giving any share issuance. This is the most practical somebody can think of. नया share issue करो, उसका shareholding कम करो. अच्छा, is it very easy to issue new shares? We are all understanding and discussing points now. Logically, it may look very easy. Exactly, Rohit ji, you have given the right. Rectify within some time, exactly. So share issue may looks very logical. Practically not at all possible. You cannot issue shares, and when you have already breached. And remember, we are not talking of small sectors. We are talking of those sectors where the breach. So if government has given a limit of, let's say, 49%, government do not want 49.1 also. So government will never allow you, okay, आपसे गलती से mistake हो गया, extend कर लीजिए. Because if they give you extend, या तो मैंने 2% बोला है, suppose 10% increase हो जाता, so government will never breach the limit. The law is given, so law would have thought it may happen, because practically how this error may happen, I am also a UK citizen, you are a US citizen, we both are entering trades, and custodian may not get the data updated for any reason. This registrar and agents make the transfers, and we both the data got not updated, and both the transactions went through. So the limit got breached. So the regulation says when the limit gets breached, they allow you 5 trading days. 5 trading days to nullify the transaction. So whichever is the last foreign transaction which is breaching the limit, that will be cancelled out. And who will bear the loss? Suppose I bought the share, I'm an investor, foreign investor. I bought the shares at 10 rupees, let's say. Within 5 trading days, the company is expecting me to cancel it. Now the shares is valuing at 8 rupees. Who will bear the 2 rupees loss? Investor or the company? This is always, obviously, the company will bear, because the error was done at company. Investor did not do an error. and that loss and the transaction which we are doing is just for your compliance purpose, not for investors purpose. So there are certain exceptional cases happens at times when the limit is breached. There is one regulation which says when a foreign company is investing in India, suppose let's say Apple is investing in India, and Apple mandates that you need to appoint one auditor as Big Four only. Then FDA has one condition. Can anybody tell me what condition they have put? Suppose any foreign company is investing in India in any company or setting up their own company, and they put one condition in memorandum that auditor has to be a Big Four company. Then what one condition FDA has put in that regulation? Any idea if anyone can think of? So they have put one condition. No. No. It is other way around. Normally they remain auditor in all other countries. No, they said if somebody is putting exactly Rajanji, you need to have a joint audit, and the joint auditor will not be a part of any other Big Four network. It has to be another Indian firm. So this was introduced because it was happening a lot of times. The foreign investors are insisting only Big Four should be the auditor, and normally the Big Fours used to have foreign offices also. So suppose if let's say any XYZ company is auditing Apple in New York, let's say, and if they say, okay, you also do in India, then it may happen that under pressure of New York company of Apple, they may ignore actual audit points in India. So they made the regulation that wherever you are mandatory mentioning that auditor needs to be Big Four, have a mandatory joint auditor. Can we issue memorandum of share? Can we issue the first subscriber of shares to those who are subscriber to MOA, the first shares at premium in FEMA? Suppose I am making a company today only. Can we issue at premium in FEMA? Let's say, for example, Apple says my name itself has a brand name. So my name has a value. So even before opening, before even I open, I know we have a brand name. So can we issue? Any who are the company secretaries we have? Any company secretaries in the group? So Swaniji, you are company secretary. Okay, so those who are company secretaries can very well understand that in Companies Act there is no section which says you cannot issue shares at premium at inception. There is no section in Companies Act which says you cannot do that. But in FEMA, it is mandatory. In FEMA, it is written that first subscriber shares, which you are issuing to a memorandum of association, first shares cannot be issued at premium. It has to be only issued at par value. Because what happened, understand why this regulation came in FEMA and why not in Companies Act, it is not there. And because we did a lot of research on Companies Act to find out any section which says you cannot do that. So Companies Act is silent on that, it does not say. What does it was happening earlier? A lot of companies are coming from abroad. Take example of Hitachi, Daewoo, any Korean companies. And when they are coming to India, they say, we have a lot of technology with us. So even if you don't contribute in money terms, our technology contribution is biggest. So issue our shares on the day one at lakh rupees, let's say. So a company is not even floated. Company is just making, you are just making subscriber to the memorandum you are issuing. And you are saying, I want the valuation at lakh rupees because we are bringing the world best technology and all. So initially it was misused. And initially when we are talking in FERA regulations in before 1999, it was misused. But then government understood that by this way, we will have a lot of problem, a lot of money, currency drain will go out. So they made mandatory in FEMA that the first setup companies can be only done at par value. You cannot go for a premium initially. Later on, you can always do a valuation, get a premium done. That is possible. Now let's understand these points again. So foreign investment means, the basic definition means any investment made by person resident outside India on a repatriable basis. So what important is repatriable basis in capital instruments of an Indian company or a capital of LLP. Only these two terms entities can receive. You can have either as a FDI or FPI, foreign direct or foreign portfolio. Sorry. Capital instruments we understand equity shares, CCD, CCP, and share warrants. Now earlier they were optionally, but now they are made mandatory. It has to be compulsory. What is the difference between equity and share warrants? If you are issuing equity, suppose take example of Geo. If Geo is issuing equity, so what does the regulation says? Suppose Reliance entered a deal of 100 crore rupees. Let's say example 100 crore rupees. So they say if the deal is more than 100 crore rupees, let's say, take 25% upfront. So out of 100 crore, 25% should be came upfront. Remaining 75% should come within 12 months. That is the regulation of FEMA. So whenever suppose he has issued shares to Facebook. So Facebook would have paid 25% upfront cash and remaining 75% will come in 12 months. Had I am issuing equity share warrants, am I issuing equity warrants instead of shares, equity, we are giving equity warrants. Then what does the regulation says? 25% upfront, and if you can note it down, just note it down. So maybe in exam it will be easy for you to recall. 25% upfront, remaining 75% should come within 18 months. That is the only difference. That is the only difference between the classification between equity shares and warrants. There is one bank which recently got listed, and they have utilized all the possible rules of FEMA. Can you think of a bank which recently got listed few months back, and they have they issued equity shares to foreign shareholders, they issued equity warrants, and they utilize all the schemes. 25% upfront liya, 75% बाद में लिया. No, it's a south based bank. CSB, Catholic Syrian Bank. And I was surprised when I did a research on this bank. I did some assignment for this bank. I was surprised to know this bank was formed in 1920s above, Catholic Syrian Bank. I thought it would be a foreign bank, purely made in Indian bank. So this bank issued shares, and the reason why this bank got listed, this bank issued shares to a company called Fairfax Investment. It's a Canada-based Prem Vatsa company. He's known as a Indian Warren Buffett. That kind of recognition he has in Canada. So he invested in this company. So they issued equity shares to this company. And why I'm mentioning you all this, whenever if you really want to understand such transactions practical, take the December 2019 quarterly report of CSB Bank. It is on a website. So in the notes to accounts, they have given full that we have issued 25%. We have issued shares against this premium. 25% we got upfront. 75% we got within 12 months. Then we also issued share warrants. 25% upfront. 18% remaining we will get in 18 months. So they explain the entire mechanism how the transaction is done, and so that is will give you a better understanding of when you do a real practical assignments later on, and you can also guide your clients also. Now there is one exception, and just note that if your issue size is more than 500 crore rupees, so my issue size is more than 500 crore. So suppose Reliance is issuing more than 500 crore shares to foreign investors, then this guidelines of getting 75% in 12 months is waived off with the approval of RBI. Suppose now Mukesh Ambani goes to the RBI and say, I am issuing 1,000 crore shares to Facebook. My issue size is more than 500 crore rupees. So 25% I will get upfront. The 250 crore I will get upfront. Facebook has requested that 750 crores he cannot pay in 1 year. Give me 2 years time. So RBI will allow that kind of leeway if your issue size is 500 crore. So that is given. That is one of the change. So this slide talks about how much time you should get the remaining consideration. 25 months, 25%, 75%. 12 months in case of company, in case of shares, and in case of warrant, 18 months. So you can read that. That slide is ignore. FDI, we understood any investment in an unlisted company or more than 10%, 10% or more in a listed company would be FDI. Last, if you can read the last slide, last para of the slide. In case an existing investment falls below 10%, investment shall still continue to be treated as FDI. Nomenclature will not change. If we understood FDI, then what is FPI? Totally opposite. Below 10% in listed companies and no investment in unlisted. FPI cannot be an unlisted company. That is the definition. Now comes the guidelines and comes the price, what is relevant. So now understand the relevance of the price. So we are talking a listed company which is frequently traded shares. Then what is the formula? The formula talks about, it is in the last two bullet points. So just note the time, weeks and days, so it will be able to recall an exam. So formula says, if it is a company which is a listed company, frequently traded shares, the fair value will be determined as what is the average high and low volume weighted average for last 6 weeks, last 26 weeks, that is 6 months, or what is the last 2 weeks. So last 2 weeks, typically 15 days, 14 days, and last 6 months. You take the average price, whichever is higher, shares will be issued at that price. Now, if you would have read few months back, probably in May, lot of industries, Chamber of Commerce, PhD, FICCI, they represented to government to remove this condition of 26 weeks for some time. Anyone is aware that this request went to government? And if you are aware, then can anybody let me know why this request went to government? Why people of a sudden says, please waive off this? 20 साल तक तो किसी ने बोला नहीं, अभी क्यों गए गवर्नमेंट के पास? If anybody can explain and think logically, you will get an answer. This is not for exam, just to tell you why people went due to COVID. So what happened due to COVID? Answer is correct, but exactly. So what
market crash.
Market crash. So what happened in the market crash? And this is where you need to understand business does not happen as per fundamentals. Business happens as per psychological impact. So what happened in COVID in this formula, and why this formula got a trouble to a lot of investors? Suppose a Japanese investor wants to enter into India after COVID. So he wants to come to India in May because he has a lot of cash. Abhi Japan mein investment to ho nahi raha. So he says, I have a lot of cash. Let me go back to India because here I can get a lot of, it's a huge market. So when he wants to come to India, we need to follow the FDI regulation of a listed company who is a frequently traded. So what does the formula will say? Formula will say, check last 6 months prices. So if I go to check last 6 months prices, the value will come, let's say 100 rupees. Then compare with last 2 weeks. And we all know the stock market almost went by 40% down in various sectors. So in last 2 weeks, the price would have come 40 rupees, assuming hypothetically. If you are an investor and your consultants tell you, and an Indian consultant calls you and say, sir, please come and invest in a company. Company is super solid gold company, very good company. But the price of last 2 weeks is 40 rupees and last 6 weeks is as 100 rupees. And you have to enter as per 100 rupees due to FDI regulations. What will you do? You will say, okay, here I am come. Or you will say, let me wait another 6 months. As an investor, what will happen? As an investor, will you jump or you will say, let me wait? As an investor, a sensible investor will always wait because psychologically, if something I can buy for 40 rupees, even though I know the worth is 100 rupees, I would not like to buy at 100 because I know ultimately it will come to be at 40 level. That is the reason a lot of investments got stalled. Money was not coming. people requested ministry a lot to waive this condition, but ministry did not remove this condition for their best reasons. But practically, this is the benchmark we need to follow, and it is not difficult. Whenever you get such assignment of a listed company, the NSC and BSC will have the data, particular script. Go to them, download it. It can be just a plain simple formula, easy for you. Now, remember that point we discussed. If it is an infrequently traded shares, if it is infrequent, then what will happen? You will go to a merchant banker or a chartered accountant who holds an experience of 10 years. They can do that. Cost accountant will not come on a infrequently traded shares. So remember, in exam they will try to confuse you. If it is infrequent, only merchant banker and CA. If it is an unlisted company, it can be done by 3. We discussed that. Okay, just one tip. Whenever you do a valuation of FEMA, you need to mention few things. One, mandatory. The valuation is done as per internationally accepted pricing methodology. Whatever approaches we discussed, cost, market, income is an internationally accepted methodology, but they're specifically looking for these words. And you also need to write, and the valuation is done on an arm's length basis. That is important. So they want to ensure that it does not happen that an existing shareholder is a foreign citizen. Suppose there is a company in India, their shareholders are foreign citizens only, and you are issuing a right issue to them. So it may happen that a company which is a value of 100 rupees, you are issuing at 10 rupees only, saying it is my own company itself, own holding company, and let me give it a cheap price. So we need to always ensure that the valuation is done on an arm's length basis. In exam, they ask a basic questions. What are the various approaches and methods we discussed last time? So know the names of approaches and methods. They ask very basic questions on that. Unlisted we discussed. The price logic we gave you from PRO to PRI. Okay, I think I did not mention the frequent. Somebody was asking frequent. Let me see. We have a definition of frequent here. Okay. Somebody asked a question on frequent, which I missed at the time. So what does the definition of frequent says as per SEBI? And these definitions are taken straight away from SEBI. They says it means if the traded turnover on any stock exchange during the 12 calendar months, last 12 months on a year, if it exceeds 10% of the total number of shares, then it will be considered as a frequently traded. Otherwise, it will be infrequent. That is the only definition. If you are selling from PRO to PRI, remember the logics. Currency बाहर जा रही है तो कंपनी तो ज़्यादा फेयर वैल्यू से ऊपर नहीं जानी चाहिए. Just think that logic. In case of swap, there is a regulation given in FDI which talks about swap. What does that mean, swap? Swap means I am having, let's say, Infosys India shares, and you are having Infosys shares listed in NASDAQ, or you are having TCS shares listed in NASDAQ in foreign country. The regulation says if you are exchanging, so I will say, okay, you give me your share, I'll give you my share, and we close the deal. In that case, whenever you are doing that, you need to get a valuation done either from a merchant banker of India or an investment banker of that country. So in exam, a question comes, in case of a swap of capital instrument under FEMA, what is the amount where you need to get a valuation done? What is the amount? Is there any amount I mentioned? So what does the regulation says? If you see the second line, if you can read from the screen, irrespective of the amount. So it does not matter you transfer 1 lakh shares, 1 crore rupee shares, or 10 crore shares. Whatever transaction you are doing which is sounding like a swap instrument, you need to get a valuation done. Normally it happens. Normally it happens for companies which have a multiple investments in various countries. So let's say there is a company in India whose major shareholders are having different countries. So they do buy and sell. So the regulation says mandatory you need to get a valuation done by a merchant banker either from India or that country. Now, can we do investment outside India? We can do the investment outside India. A company in India can buy foreign shares. We can do that. So suppose a company in India wants to make an investment in UK, we can do that. Then what should be the valuation rules? So they have given a guidelines on that. That if your investment is more than $5 million, so just note this down. If your investment is more than $5 million, suppose a company in India wants to acquire a company in UK and the investment is coming more than $5 million, in that scenario, the valuation will be done either by a merchant banker of SEBI or an investment banker of that country, whichever is you are choosing. Only when the investment is more than $5 million. Less than $5 million can be done by any chartered accountant or can be done by a CPA. RBI is very supportive. We recently did some transactions for Singapore for one of our Indian entity, one of our Indian clients. So company did not know anything. Company just called RBI. RBI told everything to the company that get a CA certificate at this language, this line. So these are very simple assignments. If you get any such kind of assignments, you don't need to be scared. Just you need to follow the basic IVA standards, document in the report that standard we are writing such things, it will work accordingly. So just take care of that in future. So in exam, a question may come, investment is 10 million, valuation should be done by whom? So more than 5 million should be done only by merchant banker and investment banker. Just note that. Now comes banking regulations. In exam, a very simple fundamental question comes on banking regulations. They ask such a silly questions. What is the full form of NPA? Non-performing assets. I'm sure majority of would be aware that NPAs are non-performing assets. Any account which does not pay principal or interest more than 90 days due becomes a non-performing. Question comes on what is substandard definition, substandard, loss, doubtful. So NPA classifications, just be aware. NPA classification is called loans. Rule is if a bank has given a loan to any company, any person, they have not and they have defaulted more than 90 days, it is classified as an NPA, non-performing asset. After getting classified as an NPA, once you classify as NPA, you need to make different categories. From 90 days to 12 months, if any asset is not paying, we call it substandard asset. So that is one definition. From 90 days to 12 months, if it is not paid, it is substandard. From 12 months, 1 year to 3 years, if it is not paying, it is known as doubtful assets. And from 3 years and above, it is known as loss assets. That is one definition. For investments classifications, how many types of investments classification RBI has? If anybody has done bank audits of statutory bank audits, they may be aware. So as per RBI, any idea you can mention that what is the regulation as per RBI? What do you think can be regulations as per RBI? Investments are classified under 3 types as per RBI norms. First is held to maturity. Now remaining 2 you can tell me. One is held to maturity. What are other 2? If anybody has remember your CA finals, or you can recall if somebody done in a banking audits, statutory audit CSA, they may be aware. After held to maturity, you should get an answer. It should be easy. Held for sale. What is the third one? Held for trading. So there are three terms which are used in the classification. So there is available for sale is the right word instead of held for sale. So there are three terms used by RBI. One, held to maturity. Held to maturity by name suggests a common sense that I am investing, a bank is investing, this bank is investing into this investment because the bank wants to keep it till the maturity. That is held to maturity. Held for trading means bank wants to sell the investment in a short period of time because bank wants to make the market movement, gain from market movements. Then what do you mean by available for sale? So I given two definitions. Held for trading, held for maturity, you want to keep till the maturity period. Held for trading, bank want to sell in a short term period to make some gains. What do you mean by available for sale then? Anybody can have any idea on that? Medium term. That's a smart way. And this is a more diplomatic way answer. So what does RBI define? And RBI defined in a very funny way. RBI defined in a very funny manner. RBI says available for sale means it is a residual category, any investment which does not fit into two categories. Either you cannot say it is a HTM or you cannot say it is a HFT. It will fall back to available for sale. So in a nutshell, what does AFS means? Available for sale means any investment which bank intends to keep more than 91 days. That's the intention. Then it is considered as AFS. In held for trading, the intent is within 90 days, bank will churn out. That is the intent. It is not necessary if the bank has said, I will call this investment as a held for trading for 90 days, you have to mandatory sell. That is not the logic. Logic is what is the bank intent? Now, why these classifications are made and what is the relevance in valuation? So the RBI guideline says if you are assigning any investment as held for maturity, then you will always value it at cost in the books, and gain or loss will be only and only booked when you actually sell the investment. Held for trading should be mark to market. That means it should be fair value. It should be done fair value on every monthly date. So monthly is the minimum guidelines they have given. That is the maximum you can go monthly. Daily is everybody does it. So if it is a held for trading, the valuation should be done on a mark to mark basis. And if it is available for sale, it should be done mark to market at least on a quarterly basis, minimum on a quarterly basis. That's the guidelines. Now, if you understood these three terms, when does this banks classifies these categories? On every balance sheet date or whenever they feel like, or there is some another answer to it? What is your answer on it? When can bank make these kind of classifications? Somebody need to answer at least. Quarterly. Daily. Bank will make this classification daily. Okay. Rohitji, don't you think daily would be too troublesome for bank if we do classification daily? Mark, I'm not sure you are answering my question, but which is the same way. So my question is, so suppose a bank has made three investments, one in Infosys, one in Jet Airways, and one in Reliance Industries. Now, does the bank can change classification daily or on every balance sheet date?
My reasonable memory says that from one to another it can happen, but I think from maturity to others it cannot happen that frequently. Something like that is there. It's not like one single rule for all.
So your memory is very good, but do not forget everything. Forget everything what you remembered, but just try. You need to answer this question on your logics. And if I'm able to explain logics, you will get the answer. I'll tell you how. Now, if the bank Swaniji views is every balance sheet date kar lena chahiye, right? So Swaniji, do you think is it a logical answer? Again, I am not questioning anybody's logic. My point is, what is the harm now? You tell me as a banker, if you come either as be a shareholder of a bank or be a governor of a bank, if your treasury team classifies these investments every balance sheet date, what is the biggest loss or what is the biggest flaw in this policy? So let me give you an answer first. The first answer: this classification is done only at the time of purchase, the day when you are making investment. 99% and generally you cannot do reclassification again and again. And if you do that, there is a penal provisions. So ideally, principally, you cannot do reclassifications. Now, if you can think logically why it is not allowed to do reclassifications, or why it is allowed only, why it is mandatory that at the time you are buying the investments. So suppose a bank is making investment today in Reliance. So a bank need to write in the memo, investment memo, that the bank is buying this investment and we will buy for HFT, HF held for sale or held for maturity. Why? If you can, somebody can throw some light on this. Why banks are not permitted to do on every balance sheet date? Because logically it makes logic ना कि balance sheet पे change कर लेते हैं. गलती तो इंसान से ही होती है to meet statute. But what is the most important reason they are saying do not?
Some are mark to market and some are not. So you have to reclassify
Absolutely.
all the previous years.
Apart from that, forget previous year. So again, sorry, I'm not able to see the name who's mentioning. So who's speaking? So it is. I always forget how much hard work it will take to change previous. But understand the concept why RBI is deadly strict against it. Because why RBI and globally it is not allowed at all for a simple reason. If you allow this provision that every balance sheet date you can change, tax impact will come last. More than tax impact, what is the hardest impact? They say if you allow your team to do this provisions classification every balance sheet date, every quarterly date, then what will happen? You will never come to know the true picture of your treasury team. What your treasury team will do, since the investment which you mark at held to maturity will be carried at cost. So suppose you have made any investment and you book that investment as held for maturity or held for trading or available for sale. So let's say I bought Jet Airways at 100 rupees and marked it as a jet available for sale or held for trading. Suppose the stock market gave it me a price now 60 rupees. So technically I need to book a loss of 40 rupees. So if I book a loss of 40 rupees, what it will show? That the fund manager is not good, that the investment team is not good, we made a wrong call, that will be shown. So what a crook investment team will do and what the crook management will do, they will change the status and say, no, Jet Airways, we want to now think to make it held for maturity. Then what will happen? Instead of booking loss of 40, I will book it at 100 rupees, so no impact will come. And that is the reason a lot of fudging will happen. So because investment, those who work in banking sector would be aware, the bonus of investment team comes from the gains they make to the bank. So the bank will never come to know how much actual gains we are making, and the treasury team will start playing with the investment. So they made mandatory that you should not change classification every balance sheet date. Whenever you are doing it first time, think thoroughly, make a classification, and do the investment. It can also happen, bank can buy same stock in 3 tranches. Suppose I am buying 75,000 Reliance shares. I can still do that. I will say out of this 75,000, I will mark 25,000 as held for maturity, 25,000 as held for trading, and 25,000 as available for sale. One stock can also be marked in different ways, but once you have classified, you cannot change stand accordingly. Valuation norms I will explain you shortly. So this slide is not relevant. Okay. So there is a guideline which says every bank will have investment policy. So every bank makes a policy that you will have investment in unquoted this much, maximum it's this limit, mutual fund this limit, particular real estate sector this limit if you want to make investments. So every bank will make a policy and the investment team has to follow the policy. SLR, statutory liquid ratios, you are aware in economics, if you are aware of SLR, CRR, that concept, statutory liquid ratios. So SLR securities are those for maintaining SLR ratio, which are almost considered as a liquid securities, where immediately you can get the money out to avoid any risk. Why this SLR concept is introduced? It is introduced because in India or anywhere in the world, the rumor spreads like wildfire. Remember, I'm not sure you are aware of that period or not. Whenever a news you would used to come in papers that ICICI Bank may default, ICICI Bank दिवालिया होने की कगार पे, एक पेपर में ऐसा न्यूज छपता है. नेक्स्ट डे क्या होता है? सबसे पहले नेक्स्ट डे के शाम को क्या होता है? हम सबके सब एटीएम की लाइन में लग जाते हैं. जितना पैसा निकलता है उतना तो निकालो, हो सकता है कल को बैंक डूब जाए. So we call it in English, we call this term run on the bank. So it may happen that there may be a negative sentiments against you. So let's say suppose something came on a bank that your CEO or your director, let's say in case of Yes Bank, your director has swindled a lot of money. So whenever a negative news comes in market, people start withdrawing first. So that कभी ऐसा हुआ है क्या? अभी suppose पेपर में न्यूज आया कि गवर्नमेंट के पास अब पैसा नहीं बचा, भारतीय गवर्नमेंट की मुद्रा कोष खाली, गवर्नमेंट इज एम्प्टी, द कॉफर्स ऑफ द गवर्नमेंट इज एम्प्टी. आप अपना पोस्ट ऑफिस से या किसान विकास पत्र तोड़वाने जाते हो क्या? यार निकाल के दे दे, क्या पता सरकार चले नहीं चले. This 19.5 was the previous regime, now it is 18%. ऐसा होता है क्या कभी कि आप गवर्नमेंट ने कल अनाउंस करा कि पेपर में न्यूज छपी, गवर्नमेंट डज नॉट हैव फंड्स, आप अपना किसान विकास पत्र या एनएससी या पीपीएफ जाके मैच्योर कराते हो? why we don't do that? Because we have faith on the government, because we know anything can fail, government will not fail, because we got a receipt that रुपए की वैल्यू, रुपए में सिग्नेचर है, मैं धारक को 100 रुपए अदा करने का वचन देता हूं, तो आई नो there is a commitment and government will honor its commitment. But that does not happen with private sector. So whenever we get a news on private sector, immediately we need to rush. So we will rush and take this out. So to avoid this RBI keeps updating this SLRs. Earlier, for long period of time, it is 19.5. Last, due to COVID, it has brought down to now 18%. In exam, they will not ask how much is the percentage for this at least, because it keeps fluctuating. So this is maintained in 1994 when Manmohan Singh ji was finance minister, and Manmohan Singh ji made a drastic step on this. If you go and Google it out, earlier the SLR, the statutory liquid ratio, was up to 35%. Imagine a bank need to keep 35% in a listed in a liquid commodity. So 35% was a huge number. Now it has been reduced to 19.5, now 18. Slowly it will go to 15, because that's where the government they wants liquidity to come. Common sense question comes in exam related to economics. If you are a RBI governor, there is a liquidity depression in the market. What will you do? You will increase SLR CRR or decrease SLR CRR? Common sense. If there is a liquidity crunch in the market, the recession in the market, I will always decrease CRR SLR so that the more money will come. So from 19.5 to they did 18%. So more money will come. A very common sense question comes in. If the RBI decreases SLR and CRR, will it increase their profit? Will it decrease their profit, or no impact on their profit? So those who have answered no change in the profit, can you tell me the logic why you given this answer? Because your answer is wrong. So I just want to understand the logic. The answer is yes, it will increase. The profit will increase. So अनी जी ने जब मैंने बोला सही है increase answer है तो उन्होंने आंसर दे दिया. But बाकी सारे जिन्होंने बोला it will not change. You tell me why. Now you tell me why the profit will increase. Since you would have some thought process on that.
Actually, क्या है कि बैंक has lot of fund to give to the market and the क्या नाम है revenue from that.
So it will always increase. That's the reason I'm saying, because so again here, please do not misunderstand me if I'm asking somebody cross questioning. I'm not trying to test your knowledge. The point which I'm trying to bring here at this in session is no book, no material can give you all 100% answers what is coming in asking in IBBI. But if you try to give some logics, and again, we only understand by logic when we are aware of. Try to think logically what may happen and you'll get. So for example, Chabda ji has given a logical answer. The more you decrease your SLR, CRR, bank will have more funds to dispose. And if I have more funds to dispose, either I will do a investments in share market wherever I want, or I will give a loan. So wherever I do, at least I will earn more than the FD. What is happening now when you are increasing more SLR and CRR? मेरा मैक्सिमम लिमिट कितना है जाने का? मैं अगर FD 6% पे FD दे रहा हूँ भी, आपको लगता है SLR CRR मुझे 6% से ज्यादा रिटर्न देंगे? They will give me even less than 6% because I will put into time deposit. तो मुझे 5.58 something कुछ मिलेगा. So even I will be increasing losses. So I will increase losses by putting more money in SLR CRR. Here government allows me to increase, put less CRR SLR. I will make more money. Right? So now the classification should be, and this classification is only as per RBI regulations. So RBI says all investment portfolio should be classified into three parts: HTM, HFT. We discussed what is HTM, HFT, and the last line AFS, which is a residual category which does not fall. And if you can read the last slide, last para of the screen, and this is a RBI regulation. RBI says the bank should decide the category of investment at the time of acquisition, and this decision should be recorded on the investment proposal, that why you are investing and why you are considering. So you will say, so bank, the investment manager will write, so we expect a huge value in coming in BPCL, so we will keep till maturity. We expect a huge value, short-term gain coming in Reliance due to foreign investment, so we will do a retail investment for a short term. So that kind of classification you need to write. HTM always will be at cost, will not be mark to market, always. HFT, at least minimum monthly on a mark to market. Remember why it is written monthly? Because these regulations were made in 1974. At that time, computer, internet was not in thought process. So उन्होंने बोला महीने के महीने कर लोगे, that is also sufficient. Now every bank does real time. Every second it gets updated in your Bloomberg and other Reuters software. So though the regulations is every monthly, it should be mark to market. For AFS, it should be every monthly, quarterly. But now practically everybody does it on every monthly basis. For unquoted investments, suppose you have invested in T-bills. T-bills are valued at carrying cost. If you are investing in government securities, suppose any government NHI issued some bonds, how do you value? There are certain FIMDA and certain regulations which gives the data, value accordingly. Bonds valuation have been done. Bonds valuation, option bonds, fixed income security. So was FIMDA was aware? FIMDA was covered a little bit. FIMDA regulations. Okay. So in RBI, whatever bonds we have, okay, Okay, if it is not called, just a one principle need to remember, just one principle. In exam, a very one simple principle need to remember. What does the regulation says? For unquoted bonds, if it is unquoted bonds, then how do a valuation should be done? It's a one-pager regulation. Don't worry. For our purpose, it is only one-pager. If you are having an unquoted bond, then the valuation should be done based on what was the last 15 days. If any other bond has been traded, which is similar value, similar features, then you should take that price for transaction. That is one price. Now, suppose there are two transactions happened. Suppose I'm having a bond with me at 10% coupon rate, and in market also there are two bonds happened, two transactions happened in last 15 days. Then I should take which one? Which bond should I take? Then it should be the last one, latest one should be taken. Okay. So just we need to remember two things. What should be the minimum size? Minimum size of the bond should be 5 crore. Just note that 5 crore, because normally individuals do not deal in bond markets. It's only the HNIs and big companies deal in bond market. So minimum size would be 5 crore. अगर 5 crore से कम का trade हुआ है तो we do not consider that. We only consider those bonds which are traded more than 5 crores. And if there are two bonds which are traded in last 15 days, if there are two bonds, we consider the latest one. सबसे latest जो हुआ that we'll consider. Anybody can tell me what is the full form of FIMDA? In exam, such a basic question came. Full form of FIMDA. If anybody can try to tell me or explain.
Sir, please repeat your question. It was inaudible.
What is the full form of FIMDA? FIMMDA. Any guesses would be fine. I am not looking for a correct answer. Any guesses, but just do not Google it. Google करके answer दे रहा हूँ तो मैं दे देता. FIMDA regulations. What is the full form? Such a basic question came in exam. If you are, because they ask you to be aware of small things also. Anybody would like to make any guess on FIMDA? No, choices नहीं दे सकता. मुझे choices देती है तो आंसर आ जाएगा. Choices तो नहीं देना मुझे. Any logics. ये आपके एक syllabus का part है. तो सोचो FI fixed income is correct. FIMDA तो fixed income correct. MM so two parts हमने clear कर लिया. FIMDA का FIMMDA तो fixed income. MM क्या होता है? Money market absolutely. Fixed income money market आगे Fixed income money market derivatives association of India. Okay, association of India. FIMDAI है, FIMDA association होता है of India आ जाता है. बाद में FIMDAI जो real body है उसको FIMDAI बोलते हैं. मैं सिर्फ FIMDA बोला derivative association. That is fine. It is not act association. So it's a NPO, non-profit organization, which gives her data. Zero coupon bonds. Anybody is aware of zero coupon bonds? So in zero coupon bond, what happens?
No coupon is paid.
No coupon is paid. We get it premium or at a discount?
Discount, or it is redeemed at premium.
Basically, it is issued at a discount and will be redeemed at a par. Without
at par
any
or premium, we can always say it will be at issue. It will be always less than par. Then only you will buy. Normally, it will always be at a high discount. And
so
then
there is no coupon in it. But what is the difference between the discount issue, like the issue price and the redemption price, is the profit.
Okay. So in exam, a very simple question came. What is the difference between zero coupon bond, ZCB, and DDB, deep discount bond? And if I give you the choices, I'm sure everybody of you will get an answer. But I'm trying to know without choices what will be the answer. So what is the difference between zero coupon bond and deep discount bond? Absolutely common sense. DDB will carry some coupon. Zero coupon itself says there will be no coupon at all. DDB itself will carry some coupon, at least some coupon. It can be 0.01%, but still it will be a coupon rate. So it will be still a, both ZCB and DDB, Harmiji will have the normally same period. That is not a, because in zero coupon also you expect, you bet for a longer period. That is the reason period wise both may have same, but the only thing is coupon. Even 0.01% can be a coupon. That is the only difference. Preferentials we carry at YTM, equity shares. Okay. A simple question comes on equity share. Normally, equity shares are preferred to value on a daily basis normally, but if it is not possible, at least weekly. Now it is possible for all. Everybody has a systems. A very funny rule is in RBI regulations, and it is still active. And I have double confirmed with somebody who is working at a RBI at a investment team. The regulation says if you are having an unquoted investment, suppose SBI has invested in an unquoted investment, and their last balance sheet is not available, latest audited financials not available, then how will you value those shares? And remember, these rules are written very long old time. At that time, MCA website was not available, public information was not available. So a query came that if you have invested in unquoted shares, how will you value the investments? And last audit balance sheet is not available. Then what does RBI regulation says? Value the shares at rupee 1 per company. This is the most funniest regulation I ever have. Suppose last 2 years there is a problem in the company. My company has gone into IBC. They could not upload the financials for whatever reason. You cannot give just 1 rupee value. But RBI says we are taking this such a strict norm so that the loss can be booked quickly. If we don't realize anything, at least my balance sheet has taken a hit. And if I realize anything, it will be a plus point and gain for my balance sheet. So in exam, a question may come, in case there is no balance sheet available on unquoted shares, what would be the value? It will be, yes, absolutely. And RBI would like to always work on conservative principle. A lot of public money is involved. Mutual fund is always valued at NAV, net assets value, whatever is coming. Commercial papers at cost, rest everything at cost, not relevant. Shall we take 5 minutes break or we are fine? So let's take 5 minutes break. 5 or 7 minutes. Try to come. 5 minutes would be fine. Try to come quickly. Come back after 5 minutes quickly. I hope you all are back. 5 minutes are over. So now let's understand stress assets. Before we understand stress assets, let's attend this one question. I think we discussed this last time. Yes, no, maybe? We discussed this last time, yes, no? This question. We discussed this, right? So it will be bank, and the logic is simple because RBI has made regulations. When we need two valuation reports for sale of stress assets, any idea? If a bank want to sell stress assets, what is the amount? No, Vishwanathan ji, my question is regarding the amount. What is the amount of loan where RBI needs two valuation? RBI says bank should get a two valuation report. What is the exposure size? Exposure should be of what amount? There should be some benchmark, 5 crore, 10 crore, 50 crore, 100 crores. So we are getting four responses. So 50 crore is the correct answer. If your distress assets is more than 50 crores, it is mandatory you need to have two valuation reports. Whatever we are discussing, these are all RBI guidelines. A bank can itself make a more stringent deadline. A bank can say, okay, for us, if any loan is more than 10 crores, we will get a two valuation done. You can do that. But what is RBI saying? Minimum, that if it is 50 crore, mandatory you need to have two valuations. If it is 20 crore, it's your choice. So in a case of stress assets, a valuation is done, and a valuation can be done internally also. A bank can also, a bank staff can also do a valuation internally. So if a bank staff is doing a valuation internally, what should be the discount rate he will use for for doing the calculations? So a bank can also do an internal valuation. What should be the discount rate the bank should use to do a valuation? Anybody else has another thought? Swami is going in a technical term. So the common sense is, and we all would have been now understanding, it should be the rate of interest on loan which I have given, because that is the cost to the bank. So you will not go to what is the risk-free rate, what is the bank prime lending rate. Suppose that the banks normally lends loan at 10%, let's say, and to particular customer I am lending 9%. So I will take that 9% rate because that is what I am having a contract. So this is what I would have estimated that I will earn 9% from this. So you'll take that part first. First right of refusal. So for example, there is a stress assets and a bank will get a valuation done. Bank will go to a asset restriction company, and asset restriction company will say, okay, we are buying at, suppose there is an asset of let's say 100 crore rupees. Bank will go to ARC. ARC will say, okay, we will buy this at 50 crore rupees. That will say. So why, even if the valuation is high, so what is the problem when the valuation is high? Because valuation can high low is a subjective term. When you would have given a loan, you would have estimated, bank would have estimated that would be my earning rate of interest. And if this is what my rate of interest, this is what the cost, this is what you are expecting. So you would have valued the company at that time. If I'm charging 12%, let's say as a rate, so you have deployed your money at 12%. So the bank calculation, when the bank would have made their budgets analysis, I would be assuming at 12%. I may get a customer tomorrow who would be willing to take at 13% because that is needy. That means bank would have would have incurred a loss on extra 1%. Or there might come a scenario where the interest rates have fallen very high. Now the prime lending rate has become 8%, let's say. So today we all FDs are getting a 6% interest approximately. So if your interest has given down, so you would have also incurred a loss. So it can work both the sides. So I will not change my fundamentals just because my number is going up or number is going down. The basic fundamental is when I am doing a valuation, the discount rate is the cost of debt which you can think of and which is not subjective. So when I have given a loan, it is that the cost we have taken. And that's what RBI has made in the principles. So RBI says if you are doing internal discount, internal valuation, it should not be less than this price. That should be your internal rate that you agree to give. So question of right of refusal. So suppose Jet Airways is with SBI. SBI got a valuation done and asset restriction company says we would like to buy it at 60 crore rupees. Can bank directly sell to RCL or bank need to go to shareholders first of the Jet and ask them, would you like to buy? Yes, no, maybe. What is your thought process? या बैंक को तो डायरेक्ट बायर मिल गया, बैंक can directly go बेचो मेरे के जाता है. Why should I go to the shareholder and waste my time? Or you need to go to the shareholder. So the regulation says bank should not directly sell to the ARC. Bank will first get the valuation, take the final offer from ARC. So bank will take an offer from ARC. Then bank will go to the who is having the major shareholder. So suppose out of Jet Airways, there would be 10 shareholders. One shareholder or a group of shareholder will be holding 25% above shares. So the rule is you go to a significant shareholder and say that we got an offer from ARC at 60 crore rupees to buy. If you like to pay 60 crore rupees, you can take the entire stake out from us because you are holding a major shareholding. So we are giving you first offer to you. If you can match the bid, what ARC is bidding, we would be willing to give this company to you. So RBI has made a regulation that whenever you are selling a stress assets, and it has a significant shareholder, you will first take the quotation from ARC, go back to the major shareholder and ask them if you like to match up the bid. If they are willing to take up the bid, you need to sell it first to those company. If not, then it goes to ARC. Now, can a bank buy the stress assets which I have sold? For example, SBI has Jet Airways, which has become a stress asset. SBI sold it to RCL, asset restriction company को बेच दिया. ARC worked on the Jet Airways, and 2 years ARC maintained it properly, kept it running now brought it to a going concern. Now Jet Airways has become perfect fine, repaid all dues, and now Jet Airways has become a running profitable entity. Can SBI again buy Jet Airways from ARC, the one which he sold? Yes, no, maybe. Yes, no answer. Maybe किसी ने answer नहीं दिया. You can buy, you cannot buy. So 2 people are saying no, rest all are saying yes. Now think from a regulator point of view. Where is regulator need to make some guidelines on it, or regulator says market rule है जो इच्छा हो करो? What do you think? Regulator would have put some guidelines? Yes, no, maybe. So regulator has put one guideline. And what is the guideline? Regulator's views is very clear. Regulator says a bank which has sold a stress asset to any ARC, the bank cannot buy the same asset back from that entity ever. Very clearly written in guidelines, regulations. Another bank can buy. For example, SBI has sold Jet Airways to RCL. RCL can sell it to Punjab National Bank or any other bank. They can buy, but the same bank cannot buy. And why RBI has put such a condition? RBI says it may happen that there can be a collusion between the banker the loan claimant, and the borrower and the ARC. So if they all three collide and they all start playing, so SBI will give loan of 100 crore to Kingfisher, 100 Kingfisher will default. SBI will sell 100 crore loan at 20 crore to Arcel. Arcel will have a value out of 20 crore. Arcel will recover value of 40 crores. So money, so the public money from bank will route to private players, and then they all will have a argument. I will not name some banks. There are some banks who are mainly dealing in buying and selling of NPS long back. Now the regulation got changed, so they floated their own subsidiaries. So all the bad loans they are selling to their subsidiaries, cleaning their books, doing a handshake, global handshake, golden handshake with the borrowers and RCL company, and making a lot of money in the back end. RBI got holds of this. A lot of bankers were put into jail, and a lot of cases are going on. So RBI, the rule is very clear. You cannot buy the same stress asset back. So coming to points, what are stress assets? So bank will have a policy. Bank should have a policy that how the valuation should be done when you are selling an asset. And Ashwat Damodaran is very well. And they when the draft was made, they quoted this policy that whoever pays for the fees of valuation, the valuation tilts towards that side. And very logical quote it is. And they have made mandatory wherever it is exposure beyond 50 crore rupees, 2 external valuation reports should be obtained. In the regulation itself, whenever you get a chance to read, so just go on RBI website, guidelines on sale of distressed assets. It's not more than 2 pages guideline, very small guidelines. It is exactly written in the same guidelines. The cost of valuation exercise shall be borne by the bank only to ensure bank interests are protected, and the discount rate should be the contract rate, that should be the minimum rate. Just note one thing, if you can note down one thing. Now, as I mentioned you earlier banks used to make their subsidiaries, SPVs, who used to buy restructuring companies, and the banks used to have 50% investments. Now in 2018 onwards, the guidelines have came and mentioned that now any bank cannot hold more than 10% in a asset restructuring companies. This is just to avoid unnecessary camouflaging of books, window dressing that has been avoided. Just note down now the percentage is 10%. Right of refusal, wherever you are having 25% and above, you need to go to the major shareholder. You need to ask them to match the highest bid. If they matches, you get it done. If they do not match, you give it to ARC. Now let us understand we discussed on examination process last time. So most of you would have, I can see most of you would have got their login ID created. And whenever you get your exam done, training done, you will be able to book exams soon. You know how the screen looks like and that thing looks like, how the exam centers look like. So we'll just spend 5-10 minutes on how the exam comes and question comes, just 10 minutes. Just give me a minute. And then we are left with SEBI regulations. I am not much excited on SEBI regulations for a simple reason that I'll tell you when I show the SEBI regulations. Just give me a minute to set up SEBI regulation also. So how does the amalgamation, what do you want, anything particular you want me to check, something you want to discuss, amalgamation? And IBC has been done? IBC?
No.
Amalgamation is not. I'm not sure. Did you receive slides or not? I'm not sure. Can anybody confirm is the slides are received? Okay. If you have anything specific in evaluation you want me to check, you want me to discuss, you can either let me know after class or you can have my number. You can discuss me. Amalgamation, only a few things you need to remember. One, for exam purpose, because amalgamation is a very big subject. If you want to know exam perspective or if you want to know practical perspective, both are different. If you're looking for exam perspective, we need to just understand what is the minimum percentage required for getting approval of corporate statutory scheme? What is the minimum percentage required to exempt the meeting? So that is 90%. If you are agreeing, you can exempt the meeting. 75% is what we are looking for to take approval. Who can raise objections? So percentage will be who can raise objections. 10% of shareholders, 5% of debtors, creditors, those who have given creditors. So these are been all highlighted there. If you can go through that, that should be fine. Do not go more than that. It is effective from which date? Appointed date, approved date, effective date. So it is appointed date, which is a little bit abnormal to understand. So these are only few things in that. So see, the Companies Act syllabus is vast, so you don't need to go through entire Companies Act. If you can just go through MCQs of these particular topics, would be more than sufficient. That's my personal advice. So let's quickly go through what has been in exam screens look like. So you will get 90 questions. 1 to 80 will be of 1 marks each. 81 to 90 will be of 2 marks each. You will get a grid like this. The benefit of this grid is, suppose you have completed 9. So I'll tell you why the benefit of grid comes. So you'll get a question on your screen. Question will look as simple as it is. You'll have 3 buttons below that, and you'll not get ABCD. You'll just get circles. You just need to mark on circles. Click on that circle and you'll get the answer get marked. You will have 3 buttons: previous, next, review. So I'm sure previous everybody understand. Go back to previous crime. Next question. Review option is for what? Review option you have given so that, suppose anybody can answer this question. What is the question? Answer of this query. Nobody with finance minister.
You can go back to the question
chat.
later.
I can always go back to later, even if I don't mark review. You can always go back. The benefit of review is the only reason the word review is given. So if I'm confused, if I'm not sure if the answer is finance minister or RBI governor, and I'm not sure, but I really want to answer quickly now. So what I will do is, I will put any answer what I feel like, what my gut feeling says. I'll put an answer, and I click the button review also. So what will happen? The coding will change. So in this screen, color coding changes. So I can see from a color coding which I need to review. So if I'm confused at, let's say out of 90, if I'm confused at 10 questions, I cannot go to each slide again and again. I cannot recall which questions I need to review again. So I have an option. When the moment I choose the word review, it will show me separately that these are certain questions where you need to again give a double thought process. So I can again just simply click on the coding number and immediately it will take me to that question again. If I left the question I do not answer, it will still show another color. So I can immediately say out of 90 questions how much I did not attempt it, how much I can. Yes, the grid is clickable. That is the objective of the grid. I can immediately start from even 81. Let's say I think I'm very good at case studies. I want to attempt case studies first. So case studies
Excuse me?
come from 81 to 90. Just a second, just give me a minute. I'll come quickly. So case study will come from 81 to 90. I can click on 81. I can start away from that. Yes, you ask, please sir, ask a query.
Actually, if we put the answer and put in review and our time is finished, so it will accept as a answer or question answer or not.
It will accept as answer.
Okay.
It will accept as answer. Whatever you have mentioned, that will be considered as answer. That is not a problem. Okay. This paper, uh, nobody has ever complained in last 3 years where I've interacted. Somebody would have said that the time is short. You will have enough time to do the paper even twice. Question number 1 to 80, you can finish in less than 40 minutes because your total time is 120 minutes. For the remaining 10 marks, 10 questions, you will get 80 minutes sufficiently. Why we can finish 1 to 18 in 40 minutes? The moment you see a question on your screen, it will take you only 2 seconds to realize you know the answer or not. If you know the answer, in next 2 seconds, you can click the answer and submit. If you do not know the answer, how much time you will take, you will never come to know the answer because these are MCQ based. Your answer, if you know, then only you know. So guesswork comes later. Now, I can always untick also. Suppose I have attempted a question. Now I think I'm not sure. I don't want to attempt it because there is a negative marking going on. So if I'm sure, I think I have done 80 questions correctly. I will receive out of 80, I will at least get 65. I don't want to attempt the remaining 10 questions. I can still ignore. And if I have marked already, I can still unmark it. In exam center, you will get lot of white papers you want. You will get a rough sheets. Whatever rough working you want to do, you can do in that rough sheets. But they will not allow you to take those rough papers back along with you. So do not spend time in writing questions in exam. Paper पूरा खत्म हो गया मेरा 120 minutes में से half an hour you let's say you have half an hour left. You cannot do let me write down all the questions which have came देख के ताकि at least जो मेरे बाकी friends उनका help कर दूंगा. Do not waste your time in exam center because they will take all the papers which they have given you. They are very strict on that. You cannot say मेहनत करिए पेपर इतना लिखा है सब वो वापस ले लेते हैं. So do not even attempt doing that. Anything you want to ask on that? Okay. Once you go to 90, because up to 89 there will be a next. Once you go 90, there will be a button called submit. What will happen if you submit the button? If you press the button submit, what will happen? क्या होगा? फिर एक बार वो पूछेगा, Are you in your senses now? Do you finally want to submit? Then the center will ask, the system will ask, do you want to finally submit? And the second time they will, so first it might happen by a mistake, you would have pressed the submit by mistake. Second time they will ask, are you sure you want to submit? The moment you say yes, your screen will immediately lock, paper will get submitted. Immediately on your screen, you will get a feedback form. So the feedback form will ask, how was the center, how was the paper, what was served, blah, blah, blah. It will be a 30 seconds feedback, yes, no, just 2 minutes, 30-second feedback. The moment you submit the feedback, immediately you'll get a result. Result will only tell you pass or not. If you pass, it will only tell you how many questions you attempted, how many questions were right, how many questions were wrong, how many left. Which questions are right, which questions are wrong, which questions are left, you will never ever come to know. So that part you don't need to focus and waste your time, so that you can ignore. It may happen at times that you are working, you are halfway through, half paper you have attempted, immediately the system crashes, your desktop goes off, power off, or the system is not responding, screen freezes. It happens at times. No need to panic. From wherever your system got stopped, they will open in another system, another computer, and wherever you have stopped, the same time will continue from there. So you will not lose anything. Their systems are foolproof, but at times we need to appreciate their systems are 20 years old. So desktop at times कभी-कभी बोल जाता है. So do not need to panic. कभी ऐसा होता है. I have seen 2-3 times people getting panicked, but no need to worry. Do not lose any patience. Remember one thing: your questions, case studies, your answer may not match 100% directly to the answer given in your exam. Suppose in exam the answer given is, let's say, 2.58 and you are getting 2.56 or 2.59. That might be the right answer. Why? Because in exam it is written what is your approximate answer, because it may happen you are using 2 decimals, the computer is using 4 decimals calculation, so you may have some minor difference. That does not mean your answer is wrong. Whatever is coming more nearer, try to do that. Normally all answers are nearby 1 or 2 decimals difference, you will get it. Any question you would like to ask? Though the regulation says all questions should be answered, that is not mandatory. You can ignore some questions which you think you are not sure. My advice would be, do not aim to attempt 100% 90 questions. Let's attempt all questions altogether. Do not do that. Never ever do that. If you do that altogether, it will be difficult for you, because negative marking kills a lot of people. So do not ever attempt all. Even if you can attempt 80 to 85, more than sufficient, because if you have done that, that is for sure. It is always advisable to use rough papers to note down where think you are very sure, so at least you get an idea. The moment you think you are sure, you are getting 70, 75. 70 is a lowest benchmark. If you think you are sure you will get 70, do not give blind shots. If you don't know, do not attempt at all. Anything you want to ask on exams before I move on? Whenever you pass, anybody who is in jobs here, yes, unfortunately, Satishji, there are limited centers. Why there are limited centers, we need to also understand, for a simple reason. They are not able to do the testing as per government policies, because government says, you need to have 6 feet distance. So if anybody has ever visited NISM center, they're very cramped centers, very small centers. Every next desk have one computer desktop. So because not only registered valuers give exam, insolvency professionals, LIC agents, mutual fund agents, KYC, NISM, so many exams happens there for various other reasons. So people don't get seats there. But seats open. Suppose if you go and check website tomorrow, you will not find any seat till December. So you will say that I will not be able to give exam. But what will happen? Every 15 days, they open the seats accordingly. Every 15 days, they will open the seats on the. So you need to constantly keep checking the websites once you complete your training, and you will get a seat. Seat will come. It will take 10-15 days for you to struggle, but it will be there. For example, suppose take example of Maharashtra now, Mumbai. So what I understand today, there has been a 144 section has been introduced in Mumbai. So it may happen they will close all the test centers for some time. It may happen. Whereas you go to Delhi, all centers started. You go to Jaipur, all centers are started. So centers are there, but it will take time. Any question you'd like to ask on this, or I was missing something? I'm not sure on exam center. Anybody has any question to ask, or we come back to SEBI then?
We have logged into NICM website. So only after getting this 50 hours certificate, we will be making the payment of examination fees and getting the seats, right?
Yes.
Or we can do something right now also.
No. You can just get your login ID created. If your
Yeah,
login ID created, it will just take a minute for you to upload the certificate and make the fees payment. It will not take time. And whenever you get passed, whoever goes exam and get passed, take a printout from the center, get a stamp, sealed, signed, and why you need that getting a stamp, sealed, signed, so that you can upload it on when you need to fill Form A. In the Form A, one attachment would be exam pass certificate. If you forget to take, then there will be nothing harm, but it will take 15 minutes to 15 days to get back from NISM other places. Yes, it is mandatory that RV should be resident of India. So if somebody who is a NRI or who takes a membership, if I take a membership from RV and I'm becoming NRI, I need to temporarily surrender my membership. I'm not sure if you get a chance to see the valuation rules. Valuation rules 2017 has a paragraph on that any RV who is becoming a non-resident has to 30 days before temporarily surrender his membership. It means as long as I am abroad, I will not sign it. Once I come back to India, I can again use this degree and sign it without giving exam. So once you pass, you can always have the right of becoming a registered valuer, but only those who are into India should practice. Because why they put this rule? For a simple reason. Because when Subramaniam ji would be earning in dollars, at least valuers like me who are in India should at least get work. So you should not have double income, right? Earning in dollars also and also taking share of our work from India. So that's on a lighter note. They want to put a regulation that whatever the business is generating should remain in India. That's the logic. Coming to question of, I was discussing on who are in employment. How many of you are in employment working with jobs? Yeah, that was the point I was asking. Anyone is in job there? In our out of all participants, or nobody's in job? Anybody currently working in job? Any organization? Nobody? all are practicing professional, it seems. Because if somebody is working in a job, the regulation says that if I'm in a job, I cannot practice as a RB. But what I can do, I can give exam, I can pass the exam today, and in next 1 year, I need to decide. Sorry, next 3 years. It is 3 years time. If I pass the exam today of valuation exam, and I am in job today, I have a time period of 3 years to decide should I quit my job and take my valuation degree. So this 3 year period is good for people who are working in jobs, let's say private sector. So within 3 years they can get a good time to build their network and start their practice. That there is a lot of people who are into jobs are doing this valuation courses. Earlier it was mandate rule that only in practice can give exam. The rule was so tough. If you check 2018 rules, only in practice people can give exam. But later on they amended the rule. Now anybody in India can give exam, but to practice you need to surrender your job. Anybody who is a director, anybody who is a executive director in the group, in any company, yes, you can be a partner in a CFM and partner in RV firms. It is allowed by council. If you are a director shareholder in public company, I'm not sure, Satishji, do you call it as a, I'm not sure, do you call it as an executive director or not? I'm not clear on that. If the term is executive director, you will not be able to register. You need to resign. Then better you transfer it to your relative or anybody else. Even it does not matter it is started or not. What matters is when you submit your details to IBBI, they will check from DSC website. Whole-time director not allowed, for sure not allowed. That I know. If you're a non-executive independent director, they will not question you. But if you are a whole-time director, drawing salary or commission, or you are getting showing as executive director, you need to resign to get a practice certificate of valuation certificate. Yes, Subramanianji, correct. That was I was mentioning. People who are into jobs, you cannot register. Now, it may happen, suppose, last 3 years I was in job. When I'm representing for my valuation, I can resign. Then they are allowing that. Then it's fine. So when I'm submitting, I can say, I was in job last 3 years, now I resigned. Then it's fine. That's not a problem. Currently, what you're doing, that is important. That is what they are looking for. That is what we need to check. They're not concerned what you were earlier 3 years before. What they are concerned is today what you are doing now. And because it makes sense, I will not leave my job because I don't know I will become registered valuer or not. Or even after becoming registered valuer, if I can't see enough opportunities, why should I leave my high-paying job? So people leave their jobs only when they realize that I will get a lot of opportunities. I'll give you a classic example now today. Just a second. So classic example today. Nowadays, go and see the IBPay website. So many merchant bankers have opened RVE. And today I got at least 5 different WhatsApp groups messages from 3 different merchant bankers who are looking for a registered valuer to join their firm as a director, either in Hyderabad, Delhi, Bangalore. And why these 3 places? At least these are 3 prime places. They want any RV who is based in Delhi, Hyderabad, Bangalore. They are willing to offer a very good salary as a directorship for the simple reason these 3 cities have a lot of startups, and a lot of startups have merchant bankers and valuation requirements and so many other round of fundings coming in. So they are looking for people who can actually take the valuation. So a huge opportunity will also come in job market. That's what I prefer predict in future. Those are interested in having a corporate jobs may get opportunity in merchant banking firms. You may get a lot of opportunities. Now comes to the SEBI regulation, very small regulations. Just you will have only small 5 regulations. It will not take less than 1,000 pages. Still, it's a small regulation. And why I always say small regulation? Because I will get any idea how much marks I will get in exam, how much question marks I will get in exam for SEBI regulation. Any idea? You can think of considering the number of regulations we have. Half it is 1 marks. So 1 marks if I'm getting for SEBI regulations by reading 5 regulations, commercially it does not make sense to anyone. If you spend so much of time in just for 1 marks, it would be better skip that and at least focus on those areas where you're getting major questions. Take example of fixed income securities. So you need to put effort there. I will try to explain quickly the fundamental points in all these regulations. My advice would be do not read. Again, it is a very irony that I'm teaching this and again I'm saying do not read because these regulations are too detailed and too long. So if you invest your time, the output will be nil but a nil. But if you can understand the basic concept which I'm trying to explain, half of the things can be cleared, which probably will help you in exam purpose to understand. So in issue of capital and disclosure requirements, so there are 5 regulations. So one regulation talks about that if you are, and this is all, SEBI will always apply for listed companies. So if it is saying if it is a listed company and you are issuing shares, how should you issue shares for listed companies when you are giving an exit price? For example, in a listed company, let's say Reliance now wants to make some changes. Reliance wants to make any changes in the scheme which people may not like. So it may happen, let's say Reliance is going to have a collaboration with Facebook. Maybe some Indian shareholders may not like it and they say, why are we doing a collaboration with foreign entities? So if anything is happening where they are changing the prices or they are changing any policies and the disgruntled shareholders want to change. Suppose now Reliance wants to change the class of shareholding. Existing class rights were there and Reliance wants to change for any reason. If somebody wants to change, then and if those people who are not interested want to dissent, so SEBI has given a formula. You pay them higher of the price, last 52 weeks price from last year, last 26 weeks price, or last 60 days price. Normally, whenever as a valuer, as a CA, you will get a lot of assignments like this because there are a lot of companies which are getting defunct or a lot of companies which are getting not frequently traded. So you need to compare, if it is a listed company frequently traded, you need to compare last 1 year price, last 6 months price and last 60 days price. Whichever is higher, that should be the exit price. If it is a frequently not traded company, then you need to get a valuation done by chartered accountant or merchant banker. If you are issuing any shares, and it's a common sense concept, if you are issuing any shares against other than cash, suppose a director or a shareholder has given a technology or they have supplied a machinery. So let's say any company had supplied a machinery or any director has given any loan, not in cash, any other property they have given. And if you want to issue shares in that, then what you need to do? Then you need to do 2 valuations. Why 2 valuations required in this? So whenever anybody has given any consideration other than cash, so 2 valuations will be done. One valuation will be of the shares of which you will issue. Second valuation will be of the consideration which you have given. For example, your holding company has given you a technology or they have given you plant and machinery. So you need to get a valuation done. If anybody is dealing with MNCs, a lot of assignment comes like this. A lot of Japanese companies, instead of paying money, they will say, we will not invest money in India. We will export the machines from Japan to India. You use this. A lot of Neemrana and Manesar, you will find certain companies who are working on Japanese model like this. So they get a valuation done from a CA on the what is the value of machine. How do you do a valuation of machine? Any idea? Suppose a company has just from Japan is exported a machine to a Delhi Gurgaon base subsidiary company, and they ask you to do a valuation. So one valuation you will do of shares price that you can do. Second valuation will be on machinery. Any idea how we will do the machinery? What will be the benchmark first? So useful life, cash flow, but the machine is not even installed. And you need to do a valuation today. Company has not even started running the production. I don't know the projections will come or not. So there are 2 ways. One, check what is the comparable price in market price. Second, whenever a foreign machine comes from abroad, a custom valuation happens generally. So at the custom they would have paid some duty. that custom duty would be your benchmark, that at least this would be my value. That can always safeguard you at the time of your review. That if custom has considering this value, bill of entry would always be a benchmark for you to value. That yes, it cannot go at least below this cost. Because try to put yourself practically as a CA or as a company secretary or a CWA, we may not have that much expertise to know the future value of machinery. So whatever is the replacement cost available, I can take from a bill of entry and use that as a base. Insider trading regulations, we all understand should not be done, but we also know so many insider regulation happens. And agar aapko abhi, if you are aware of recent cases, few weeks back or months back, it came. SEBI did an inquiry. Somebody circulated the the financial results before publishing on WhatsApp. SEBI even traced that wherever we have issued, from which side we have issued, who has bought on these trades. So insider trading has been active. Practically, a lot of people do that. But SEBI is putting so much of checks and balances. Any idea what do we mean by insider trader? Who is considered insider trader? Insider trading, anybody who has UPSI.
Who have shared the information which can influence the decision of the investor.
Okay. So an exam, a simple question comes. What is the full form of UPSI? UPSI. So UPSI, so the definition of insider information is anybody who has UPSI, that is unpublished price sensitive information. If you have any information which has insensitive, which price is sensitive, it may be financial, it may be non-financial. What does that mean? Suppose tomorrow tomorrow Ratan Tata, an entire board is going to resign, and a new board is coming. Let's say this Mistry is coming back on the board. It will make the price up and down. It will be somewhere sensitive. So you cannot even share this news before it comes to public. You cannot say, I know Tata will going to put resign because I am their secretary. I know they are drafting a letter. So it is a non-financial information. Still, any information which has a sensitivity to price variance, you are not allowed to disclose. So who are considered insiders? Those who are holding key management positions, all directors, all CFOs, CEOs, MDs. Is auditor considered as a insider trader? Does he hold sufficient information? Yes, no, maybe. Even auditor and audit team are also not allowed to disclose the listed companies. So if anybody does audit of listed companies, you need to sign a NDA that till the results are published, you will not share financial information with anybody. And nowadays, even WhatsApps are being tracked, so you don't need to circulate ever. Any idea how much is the penalty if somebody came to know that he is an insider trader? How much amount is the penalty? Any idea? Any vague idea you can think of? 20 lakh ki penalty, 25 lakh ki penalty. 3 times of profit is one of the partly correct answers. 3 times of profit is one of the answers. So penalty terms is 2. 3 times of it is higher of 3 times of the profit you earn, or if I tell you the amount, you will never ever believe that no, this cannot be possible. And when I read the regulation, I say they're going crazy. Who will pay this kind of amount? Multiplied by 25 times, Shushantaji. So the penalty says 25 crore rupees or 3 times of the profit, whichever is higher. So minimum will always be 25 crore rupees, the benchmark. Why they put this kind of regulations? To create a panic in the market that people should not do, because a lot of fund brokers, a lot of SEBI and a lot of other officials who had some tips, inside information, they do and deal with this. There is also jail term. It's huge. So I'll skip questions. Questions you can always do that. Slide will be with you. Those questions you can always go through. I'll just take the concept. Insider is known as any person who is a connected person or who has any information which is unpublished price sensitive information it can be an auditor, it can be a management, it can be company secretary. Trading means either you should buy or sell, nor even you can pledge. Even pledge is also considered as a trading. You cannot do any activity dealing with that. So who should not do it? Nobody should do it. I'll take the relevant part. Okay, now understand the few important points. Now, the law does not say that if I am a MD of a company, let's say I am a MD of HLL, which is a listed company, it does not say you cannot trade into that share.
Sir,
Boliye.
hello.
Yes, sir.
Actually, I got a information for a company that they are going for VRS in a big scale, and they
Sir, I lost your voice in between.
I mean, insider trading or what?
Hey, you know that they are going to announce VRS. Is how did you get this information? Is it a public information? Company has announced somewhere, or you got an insider tip? So see the things they need to focus is how did you get the information? Is that information was
Hello.
available? So the query would be, how did you get this information?
Someone is circulating in the WhatsApp. There is a very big company and they are giving the VRS in big scale.
Okay, so you did not receive, right? It's not that you got the information from the management, informally from the management. It is if it is coming in public domain. So if something is coming in public domain. So suppose if I Google it, let's say you got this information that let's say SBI is giving a VRS to so many employees. You are getting this information from a WhatsApp. If I put this on Google and if I get this information from there also, so that means it is publicly available. But if the HR head of SBI, he messages you only that today we have decided this and within 2 3 days we will final the VRS scheme. If only you are recipient, then it is a insider information. But if I Google this and everybody is able to see on Google, then it does not become an insider information. Then it becomes a public opinion. For example, shares. Let's say, for example, shares. Result have not published. Tomorrow is the board meeting, and I know the results today because I am a printer. जो प्रिंटर पब्लिश करते हैं ना रिजल्ट्स को, मैं प्रिंटिंग प्रेस में हूँ, मेरे पास रिजल्ट आ गया और ये रिजल्ट मैंने व्हाट्सएप में सबको भेज दिया मेरे दोस्तों को, देन दैट इज अ इनसाइडर इन्फॉर्मेशन बिकॉज ये गूगल पे अवेलेबल नहीं है. जो चीज पब्लिकली सबको अवेलेबल है दैट इज नॉट इनसाइडर बिकॉज सबको पता है, पब्लिश्ड होगी ना, सबको पता है नेट पे मिल रही है. But which is sensitive only to you, specific only to you, that will be considered insider. Now, what is expected? The law does not say the KMPs cannot trade in that. I can always trade in that. If I am an employee of, if I am a CEO of a HLL, why can't I invest in those shares or why can't I trade in those shares? I can do that. What does the regulation says? Regulation says, if you have joined the company, सपोज आज मैं HLL को ज्वाइन कर रहा हूँ, मैं CEO पोजीशन पे ज्वाइन कर रहा हूँ HLL को आज, then whatever holdings I have, मेरे ज्वाइन करने से पहले how much holding I have in HLL, I need to inform within 7 days of joining the company that मेरे पास आपके पहले के इतने shares पड़े हैं, so that I need to inform to the company. After that, regularly after that, whenever I do any transaction more than 10 lakh rupees buy or sell, within 2 trading days, I need to inform to the company. And the company will tell to the stock exchange within 2 days of receipt of information. Suppose I did a transaction today, मैंने 20 lakh के shares बेचे, I will inform my company tomorrow. The company will, in next 2 days, will inform to stock exchange that our KMP has done a transaction. That is allowed. When you cannot do insider trading transactions, when KMPs cannot do, when you are in a lock-in period. So before the results are getting published for next 30 days, a lot of companies stops it. A lot of companies says we will not do any trade. So that you need to disclose. And when we say insider, not only you, your wife cannot, also relatives cannot do that. If you see the imprison, the punishment, 25 crores or 3 times, whichever is higher. and imprisonment up to 10 years. So that is a very harsh penalty. Now, substantial takeover regulations. Takeover, we understand. Takeover regulations means somebody is trying to take over your company. Anybody can take over your company. How to safeguard your company? So there are two kinds of takeovers in public. We call it either hostile takeover or friendly takeover. Hostile takeover is not permitted. That's the reason these regulations have been put. Friendly takeover is permitted because you are taking slowly, and everybody is aware, and the company is knowing that somebody is taking our management slowly. So if I am buying 555% shares of Reliance Industries, they know that okay, I am 555, I am getting so many shares, I may take over. But suddenly tomorrow, let's say Anil Ambani buys all shares of Facebook and so many venture capitalists will come and goes to Mukesh Ambani and says, now I am your boss. That will not work out. So to avoid all these kind of hostile takeovers, SEBI has made a regulation. So regulation talks about frequently around this question you can go to. Regulations talks about when should be disclosed, what should be disclosed. Whenever you are holding more than 5% of voting rights, you need to disclose to the company that I am holding. That disclosure is made. And that is the reason you will see in all our reports, all reports of companies, we give a disclosure. Following persons are holding more than 5% of shares. That comes from the SEBI regulations. So SEBI started with this, and for a better corporate governance, they put into Companies Act and accounts also. So everyone needs to disclose more than 5%. Then whenever a changes happen more than 2% up and down, you need to give disclosures to the company within a 7 days. Now, when are mandatory disclosures required and when are normal disclosures? Your judicial pronouncements happen? I'm not sure. Judicial cases happen? Judicial pronouncements tomorrow. Okay. So there you will get one case law which will be on substantial acquisition. GL Sultania versus SEBI. They will get more understanding of this substantial acquisition, how the cases happens. The rule says whenever you or your friends along with a group, so suppose me and my 5 friends, when we are acquiring any company shareholding more than 25% together, we need to give a public open offer. We cannot do a silent acquisition of acquiring more than 25% without telling public no. So that is a mandatory rule. If I'm already holding more than 25%, I'm already holding 30%. Then if I'm holding more than that, it is my choice, not compulsory. What does the regulation say and how do we do that? Regulation says if somebody is acquiring first time more than 25%, you need to give a public offer so that people are aware who is buying all, and it will not be a surprise. If you have holded already 25%, and every year you are holding only 5% increment every year only, you don't need to give any public offer. It is allowed. But if you are holding 25% and again now you want to take 25% immediately with some group of consortium, you need to give a public offer. And you need to give disclosure every year end who is having more than 25%. You need to give to company within 7 days. Now, if I am giving a disclosure, what should be the offer price? Now, again, it is for a listed company, so it can be frequently or infrequent. If it is a frequent, your price will be the higher price. So if I am saying I am going to acquire 25%, 30% shares, the offer price will be higher off. So it will be higher of first price, what has been negotiated. Suppose tomorrow you will get a case of GL Sultania where two brothers decided we will sell at X price. So whatever the price you agreed to buy, that is one. Second price would be last 1 year, what would be the highest price? Third price would be last 26 weeks, 6 months, whatever is the highest price. And last would be last 60 days, trading days, whatever is the highest price. If it is fitting in these four, whichever is higher, that will be the offer price you will give in the market to acquire shares. If it is infrequent, in infrequent you will not have, you will just take first three prices higher, last whatever the agreement between two shareholders, last 1 year, last 6 months, and in frequent you don't take 60 days price. In frequent, then you go for a valuation from a CA or a merchant banker, where you go and say that give me a valuation, and that valuation price, whichever is higher, will be considered as an offer price. So just need to remember these 4 points, that if it is a frequent traded, what will be the criteria, or which will be the higher price. If it is infrequent, what would be the criteria. For delisting, there are two kind of delistings. Need to understand: compulsory and voluntary. Suppose I am listed in two shares, two stock exchange, NSE and BSC. So what does a delisting says? If you are compulsory delisting because of some regulations, so you need to inform your shareholders and give an exit price. If you are having two stock exchanges, NSE, BSC, and you are delisting from one stock exchange, what should be given to shareholders? Should I give a fair value to shareholders? Yes, no, maybe? Quickly answer. Then I don't need to do anything. Why I don't need to do anything? If I am having two stock exchange and I'm only just delisting from one stock exchange, there is another stock exchange already available, so I don't need to give any fair value. Only in case of compulsory, where you're exiting from both share stock exchanges, delisting, then you can need to give a, exactly, that's the point which I want to bring, that apply your logics. अगर NSC बंद हुआ तो BSC में trade करने से किसने मना करा? You can always trade that. So the intent of the regulation is, if you are closing all the doors, if you are compulsory delisting from all the exchanges, then you need to give an exit price to the shareholders. And how the exit price will be arrived? Either by a merchant banker or by a chartered accountant. Registered valuer is still not there in that. Merchant banker or chartered accountant can be there. Questions you can always do that. So compulsory delisting only happens when government gives you any penalty against you. Voluntary is when your choice. Just remember that. If I did a delisting,
Actually, sir,
yes, sir.
in future, कि there is a new institution is coming for valuers. So all the valuation will come in this or not?
All will come in this. Mandatory. All will come in this. All will come. That will come. Now there is need to understand one thing. If I have been a delisting done, okay, today, then for next 10 years I will not be able to list again, because it may seem that you are trying to play with the market. जब भी market बढ़ता है, delist करके निकाल लेते हो पैसा, वापस आते हो, तो they put a condition. So delisting, lot of people have made the games, taken money from public and announced delisting. What will happen? Suppose I issued a shares. Let's say today Root mobile IPO subscription came. We all apply to Root mobile IPO. I have given all allotments. You all would have bought at market price would have been 150. You all bought at 350 because market has gone up. And tomorrow I say, now I am delisting. Then you will get 350 price, which on which you bought. The valuer will give you what the price, which is fair market value, which will be, when it comes to my balance sheet, it will be then less than 100 rupees. So you will incur a huge loss. So that kind of avoid that kind of rules. They avoided this regulation. So in delisting, just remember, if it is a voluntary, you don't need to do anything. Penalties just need to read. Probably you can go through slide. Any company which is having less than 10 crore capital, net 25 crore, they do not get a delisting criteria. Small companies are exempted. Any listed company which is small company, you don't need to go with these regulations. That's very small regulation on ESOPs. You just need to understand two things. Do not go the regulation is very tough, because if you don't know how to do valuations options, it will look a little bit complicated. Just understand two, 3 points on ESOP regulations. Any company can issue ESOPs. To issue ESOPs, there is a term, grant date, when the company decides to grant ESOPs to you, at that time valuation should be done. This valuation can be done by a registered valuer, can be done by a chartered accountant. Anybody can do it. After grant date comes the vesting date, where the conditions are there that company should hold for, you should hold for 2 years, 3 years, you stay with the company. Then comes the vesting date. After your vesting dates get over, then comes the exercise date. Exercise date is the date where the employee decides should he acquire the shares or not shares. Whenever the exercise date comes, the valuation will be done by a merchant banker only, because in exercise it is considered as a perquisites. In perquisite, valuation can be done only by merchant bankers. So you need to take care of that. Rest, nothing is on ESOPs. Just remember these two things. Who cannot be granted ESOP? Just remember that independent director cannot be granted ESOPs. Directors cannot be granted ESOPs, and promoters cannot be granted ESOPs. Just remember that. These things cannot, these persons cannot be granted. Just remember that. Rest, we don't think much on that. Okay, just one more thing. As per SEBI regulations, minimum vesting period is 1 year from the date of allotment. That is the minimum vesting period from the date of allotment, not from the date of announcement. You cannot give a ESOP today and say tomorrow you can encash. That cannot be. You can have to give at least 1 year. Why ESOP? So that the employee should stay. So that try to note this period of vesting period. How much time we? I think time we exceeded. Just give me a minute. We are already. We are. You did Indes is done for you. Not it done Indes. Okay. So Indes, whenever happens, read thoroughly Indes, because 5 marks comes straight away from Indes. Options happen to you? Options? Option valuations done? Okay. In exam, a simple basic question comes in option valuation. A very simple basic question. What is the difference between American option and European option? A very basic simple question. Anybody who can answer this? Or anybody who is not clear on this? It is very simple. If you just need to understand one simple fundamental concept, I am not able to see the charges.
American can be exercised any time before the expiry, but European only on the expiry date.
European only on the expiry date. So just remember, there are simple concepts on American option, European option. Option means you have a right to buy or right to sell whatever you have. America starts with A and A starts with any time. So American option can be exercised anytime. Europe starts with E, that is expiry. So it can happen only on expiry. So just go on basic concepts. Even if you're not good at fundamental concepts, go to a website called investopedia.com. That website will help you to resolve so many jargons, which if you're just aware of basics, it will be good. I have not seen your material, but in options, you'll at least get 5 marks question on options. A fundamental question will come on options. Your duration is increased. So suppose your option was for 2 years, now duration is increased to 5 years. What will it have an impact on call or put? So there are 6 factors. You just, whenever you Google on Investopedia, you'll get those 6 factors which impact your options. So you'll get an idea, will my put option will increase? Will my strike price will increase? So put specific emphasis on that options, because these 5 marks will be if you can understand principal fundamental concepts, it will be a cake away. If you ratify, it will be difficult. But just go through Investopedia. I have not seen your module, so I cannot say how much it is covered in your module. But these are very basic things which anybody can, even if you're not hardcore FM guy, still you read Investopedia, you'll be able to go. Anything which is left, again, syllabus will be huge. You just need to start booking a day, practice. A lot of MCQs are available. There is a website, YouTube channel called Power for Prep for Insolvency and Valuation. Google that YouTube channel. A lot of MCQs are there. Read as much as possible MCQs. You will try to get answer. Papers are getting repeated again and again. Questions are getting repeated. Read all the sample papers, and you'll get an idea by next week how much you have. I'm not able. I'll try to send you the screenshot of that YouTube channel. It is some Power for Prep. Maybe on your WhatsApp group I'll send. You can do that. I need to recall what is the name. So I'll need to. I don't know. It is not my channel. Somebody else's channel. So I'll just send you that shortly. So I think thank you all for your patient hearing and whatever time. I wish you all the best and see you soon and seeing you as a registered valuer. Hopefully, I'll see you as a professional on the other side very soon. But just don't delay the exam. That is my humble last request. Have a good day. Take care. And don't afraid of exam. Just give it. डर के आगे जीते माउंटेन डू पियो और एग्जाम दे दो जल्दी से. Okay. Have a good day all. Thank you.